So this is Jayant Pluri, Chairman Sikasa of Vijayawada branch. So I give a hearty welcome to all of you for the current session, which is a 5-day session refresher course on 360 degrees of our annual report. We have already completed 2 days. This is the 3rd day, where we have joined by eminent speaker Chennaswamy Ganeshan sir. So we will start our meeting with our motto song. You need not stand. You can place your hand on your heart as a matter of respect.
येष सुप्तेषु जाग्रति येष सुप्तेषु जाग्रति कामं 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 कामंशो पुरुषो निर्विमाणः निर्विमाणः तदेव शूद्रं तद्ब्रह्मा तद्ब्रह्मा तदेवामृतमुच्यते अस्मिन् लोकः शितः सर्वे
Great people, I say, all of you, very good people. Really, I'm missing all of you. How are you, sir?
Yeah, thank you, one and all.
Yes,
so,
I must see you exactly. There's no question of talking in more phone. We should meet in person.
Our chairman, Kadam
Even though
Sharda,
all these problems are...
I request all to Okay, sir. Respected Central Council Member, Program Director, C.S. Priya Kumar, and Speaker of the today's technical session, C.S. Chinnaswamy Ganeshan sir, and colleagues at Managing Committee and past Chairman of the branch, and Coordinator of this program, C.A. Godavarti Srinivas Rao, and my dear fellow members, good evening to one and all. And my hearty welcome to you all for the 3rd day of 5 days virtual refresher course on 360 degrees of annual report organized by Corporate Laws and Corporate Governance Committee of ICA, hosted by Vijayawada branch. And today we are very glad to listen from Priya ma'am. She made time to address us even though she is so busy in ICA activities. Thank you so much, ma'am. And our today's topic is practical issues on Schedule 2 and 3 of Companies Act. Schedule 2 of the Companies Act defines useful life. Useful life of an asset is the period over which the asset is expected to be available for use by an entity, or the number of production or similar units expected to be obtained from the asset by the entity. Likewise, Schedule 3 of the Companies Act. It provides the format of the financial statements of the companies complying with accounting standards AS and Ind AS under its division 1 and 2 respectively. Today's speaker, Chinnaswamy Ganeshan sir, is with us to have insights into the practical issues on about 2 complicated concepts. Thank you, one and all. And I request you all to enrich yourself from that session. Thank you.
Thank you, madam. Thank you for your opening remarks. I request GSR sir to address few words about the current topic and also about Priya ma'am. Over to you, sir. Sir, unmute yourself, sir.
Unmute, sir. Please unmute. Sir, GSR, sir, please unmute.
Yes, sir, you are on mute.
Yeah. Just. It's a great pleasure. Good evening, one and all. It's a great pleasure in introducing the dynamic lady genius of CA Priya ma'am with his illustrious Silver Jubilee career over 25 years, Silver Jubilee career. She has been a member of the SIRC from 2013-16 and also member of Central Council 2016-19 and also 2022 and 25. So Coming to the personal things, she has an illustrious silver jubilee career in the industry and practice, qualified as a chartered accountant in the year 1996, an alumnus of DAV Higher Secondary School and Ethiraj College for Women. She has a proven ability to build and lead CA teams on professional, academic, and social projects, excellent interpersonal negotiation and communication skills, and she is well versed with the contemporary technologies, specializes in the risk and corporate loss advisory, and also insolvency laws, and keen to abreast all the professional challenges and willing to share the knowledge. She is experienced in working with the other government and regulatory bodies such as Ministry of Company Affairs, Ministry of Finance, IBBI, ISCI, and IIP, and of ICAI, etc. And coming to the work part of the ma'am, she's a member of the Southern India Regional Council 2013 to 16, an ex officio member of Coimbatore, Vellore, and Tuticorin branches. Launched a personal knowledge support, an initiative in 2012, very, very important and very, very support for the all chartered accountants across the globe, even including myself. I am benefited by this smart CA concept, which supports small and medium practitioners with kits, checklists, and tools garnered over 10,000 users to date and delivered through mails, app, and webinar series. She's a member of Central Council member 2016 and 19, and served several standing and non-standing committees, including executive management, examinations, peer review board, financial review and reporting board, CPE committee, corporate law committee, etc. She is the first chairperson of the leadership committee on the South Asian Federation of Accountants. Coming to the current she is a member, elected member as a Central Council member, and she has been chaired an expert advisory committee, a women member empowerment committee, including and also corporate laws, corporate governance advisory committee. And also, apart from this, she is a vice chairman for the Committee of Insolvency and Bankruptcy Code. And apart from this, more than 22 committees she has becoming taking part as a member. And so with this illustrious profile of this magnitude, I present to you all Sri Priya ma'am, to the members. I also request Chinnaswamy Ganeshan sir, welcome to the today's session. Thank you, sir. And over to ma'am to your message to our members.
Thank you, Srinivas sir, and I'm very honored and very flattered by the use of your very generous and liberal use of adjectives. But I must hasten to add that all my knowledge and experience would anyway stay humbled to speakers like Mr. Chinnaswamy Ganeshan, who does a very unconditional job of being there in ever so many forums. And it's certainly not, and all the members, the managing committee members of all the branches, who I think are the actual fulcrum and cornerstone of this ICAI. We do work in the Central Council because of the great work that happens in the branches and because of a lot of pro bono efforts of people like Chinnaswamy Ganeshan sir in contributing to our body of knowledge. So on behalf of the Corporate Laws Committee of the Institute of Chartered Accountants of India, I take great pleasure in extending a very warm and a very hearty welcome to all of you to this program on 360-degree view of the annual report. I must tell you something very interesting. I'm going to copy this idea. We are just going to do this as a series all over the country because I've been thinking about it by adding a few more topics and making it a 6-day program. We're actually doing it, but in a different name. But I think this name is very, very catchy and compliments to Srinivas sir, in fact, who's been consistently behind to make this effort. And I know what it takes to organize a program. So it's kudos to all of you. So to the managing committee members of the branch, CA Shrita Shireen, it's always nice to see women at the helm. And it's very nice, not to say anything else, but it's nice to see a lot of us coming forward. To Mr. Narendra Babu, Mr. Ravi Kishore Nitta, who's here today, Mr. Narayana, the treasurer, Mr. Lakshmi Krishna Jayant, the SICASA chairman, Mr. Venkat Subbarao and Mr. Vemuru Veerapavan Kumar. So here's a very hearty good evening to all of you and to all to the members. You certainly have a far more valuable session on Schedule 3 and Schedule 2, which is coming in the next few minutes. So I'm not going to hold you very long, and I'm not going to speak on what the speaker is going to speak. But I'd just like to place some thoughts before you on where we as a profession, as auditors, are heading. That's maybe just 10, 12 bullet points that I think we need to take back home and think about how we ought to make ourselves better, more in a national context rather than in a personal or a professional context. And I think that's the expectation of the stakeholders today. Are you doing the right thing for the country by certifying financial statements? And it's no longer a micro view that we seek to, sort of accomplish. It's a macro view. And that's why you have speakers like Mr. Chinnaswamy Ganeshan who will actually tell you the why of Schedule 2 and Schedule 3 rather than just the what. So where are we today? We are at crossroads. You've seen the arrests of chartered accountants. You've seen the issues regarding Chinese companies. You've seen notices on shell companies. Any day you open the paper, you find that I saw a paper report, a couple of input tax credits are happening. So what's the first thing that I want to talk about? I want to talk about the fact that there is a huge expectation of the audit profession. And there is a huge gap as well. So what's an expectation gap? So for the next 2 years, you'll keep hearing this term very often. There are two kinds of expectation gaps. One, what you think you're doing as an auditor versus what you should do. What you should do is, of course, there in the Act, the standards, the various legislations, pronouncements. Two, if the standard auditing says, please get external confirmations, am I doing it? So there is one gap here. What an auditor ought to do versus what an auditor is doing. And I think it's fairly significant today, and we need to be more careful. Careful in every component of the balance sheet, of the financial statements, or any work that you do. The second issue is much, much larger. That expectation gap is what the market or the stakeholders think you're supposed to do versus what you're doing. The market thinks auditor has to find all frauds, all diversions, everything, all, even in this case of the recent input tax credit issue, why didn't the auditor pick up? Now that is an expectation gap that's very difficult to address. Having said that, see, today today whom are you serving? You're serving the stakeholder. You can go back and say, no, my standard on auditing says this, my Companies Act says this. What's the solution to managing this expectation gap? There are two questions. Should I even bother about this expectation gap? I think the answer is yes. Because a profession exists for the society. We don't exist for ourselves. So you need to somehow manage this expectation gap. How do you manage this expectation gap? Just two words. One, common sense. You're the auditor of a company and you're also auditor of several group companies. Can you write a line that says confirmation of balances could not be obtained? Does it work? Think about it. Small things. Fixed asset. Your client has obtained a term loan. Won't you slightly figure out what is the end use, is the mission there, etc.? That's common sense. The second thing is professional skepticism. In the many failures that we've come across, the disciplinary, etc., I find more issues of lack of professional skepticism rather than collusion. I wouldn't even call it negligence. Somebody said, oh, Priya, it is a big listed company. He said, we trusted the CFO. Today, as an auditor, you trust and verify. But after these set of workshops tomorrow, please change your mindset. You verify and then you trust. This is possibly the first point that I want to make. And the president ICI also had said, see, audit is serious business. If you want to do audits, even if you have to do one audit, you still have to study the whole thing. So there are two ways to look at it, to say, look, I might want not to go into attest, But I don't think that's a great idea, because if you don't attest a financial statement, somebody else will. So try to become a good statutory auditor and then get as many clients as possible. So the second interesting issue that I'd like to talk about is fees. And I think about the fee part of it, the more spoken, the better. And I've now made it a point to make this statement in every address. And I also request all faculty to do it, because I think we seem to be the most undercharged profession in the country and even vis-a-vis the world. The kind of risks, the kind of responsibilities you need to take, please cognize for it. Today, the entire scope of audit has expanded enormously with the coming of the Schedule 3 and this new CARO. The revised Schedule 3, the revised CARO, and what I told you first, the perception of the auditing profession. You need to work fairly defensively today in terms of your documentation. Now, I was talking to an auditor yesterday, and I said, "So what about your working papers?" He said, "My whole office is filled with working papers." You're paying rent. Are you costed for all these adequately? Again, a matter of an audit fee is a discussion between you and your client, but please do charge well, because nothing in this world is good, fast, and cheap. It can only be 2 or 3, and most of our clients come to us in the end. That's the second point I wanted to make. The last point that I'd like to speak about is CARO and Schedule 3 itself. Why did we need a new Schedule 3? Why did we need a new CARO? If you notice, the CARO 2020 came first. And then, as I say, I went back to the government and said, look, you're asking the auditor to comment on so many things where the management has not commented. So they said, okay, we'll wait. So they brought in a revised Schedule 3. Now, this revised Schedule 3, if you only look at K, which is additional information, it's as big as the original part of the Schedule 3 itself. So it's a lot more responsibility. And these two changes will have an overriding impact on everything that you do, whether it's your auditor's report, your CARO, your ICOFR, your P&L, the balance sheet, the statement of changes in equity, the cash flow statements, etc. Now, what is so different about this CARO and this Schedule 3? So very few legislations in the world are proactive. Nobody makes a law because the government likes to make a law. People make laws, rules, and regulations because there has been a problem. They are reactive. And in this case, I think CARO and Schedule 3 are reactions to corporate misbehavior. Are they reactions to audit misbehavior? I would think lesser. See, look at this government. It's like this Kali, right? The Raktha Bija story. The Kali who sits in the Calcutta temple. So out of every issue, every time Kali slayed a demon, there was a new demon that was coming up. That's why he's called Raktha Bija, which means the seed and blood is the combination of the name. So this government is something like that. They're trying to do everything to try and curb a problem. And I think they finally looked around and they said, look, who is that we can place some trust on? They said auditor, which is why, in my view, you have a revised CARO. It's a larger trust that's been placed on the audit community. As an offshoot of that, what's another interesting thing that I see happening? Please don't think that by being a chartered accountant, you're going to be protected. I think even the ICAI today stands in a very different league altogether. Our practices are also constantly being challenged, saying, can we do this better? I think the next 5 years will see a huge amount of pressure on every single institutional framework in this country. Today, SEBI is being looked at in the aftermath of the NSE scam. RBI is being looked at. Why did so many banks fail? All banks, commercial banks as an institution, are being questioned. RBI has now started a CRILC reporting, where every loan above 5 crores, they have to report to CRILC on the daily status, on the status of the loans. Other regulatory authorities, no, ICAI, chartered accountants, there will be a change. There's already a new CA Amendment Act that's rolling and in progress. ICSI, the company secretaries will be questioned. So this is the ambit where we are today there. So please be very conscious of the fact that today, if X makes a mistake, it's X makes a mistake. But as a chartered accountant, if you make a mistake, they say all chartered accountants. That's the unfortunate tag that gets latched on, but please be careful. Again, I'm not saying all this to scare you, but I'm only saying that you must be a confident chartered accountant. You must say, I know my standards, I know my law, and I will do it exceptionally well. And I will charge for it. The next interesting thing that I'd like to speak about is, if you look at the role of an auditor, it's very simple, right? Audit is the process by which you express an opinion on the financial statements of an entity. It's basically true and fair. And true and fair meant two things. One, that the financial statements have been prepared in accordance with an applicable framework. In our case, Schedule 3. And the second thing is, there are no material misstatements, whether it's due to fraud or error. So one significant change I see now that's happening is, audit was always about solvency, correct? Assets, liabilities, balance, etc. Now, after ILFS, audit has moved, I think, very significantly to a liquidity kind of situation. You're being asked about ratios. Do you believe that the company's short-term assets are enough to pay liabilities in a year? So I think the entire audit profession also has undergone a complete change. Solvency, going concern was always an auditor's aspect to comment on. But today you're asked to comment on liquidity. Think about it. It's different. So what are the safeguards that we would do to go back, re-examine the way that we do audit? Similarly, the fourth thing that I'd like to speak within this subsection that I'm talking about, which is Caro and Schedule 3, is look at the changes. Today, one way is to say, okay, I will go and I will just audit as per the change. But I think what will be very useful is to understand why that change came. Today, from previously having disclosed loans and advances to related parties, today they want you to give everything. So the other interesting thing that's happened today is, I think the new Schedule 3 has changed the concept of reporting from merely financial reporting to more like a management reporting. Where would you comment on CWIP aging? It'll all go to the board. You prepare a statement and say, this is my aging of CWIP. Today, you're required to report on your aging of CWIP to your shareholders. It's very, very different. And see, they also use these very subtle terms. Cost overruns, time overruns. Chinnaswamy sir will talk about it. It says whether cost is an overrun or a time and an overrun on a project. Now, when will your client be able to know whether there is an overrun? He has to have a base budget, correct? He should have said my work has to get completed by X date. Now there's a time overrun. This is my cost. So kind of go one level below what they're asking you to report on. And then I come back to the same two words I used earlier, which is common sense and professional skepticism. Now, why did this change happen? If I were to just sit back and think on why this change has happened, I think one significant influencer could have been the Insolvency and Bankruptcy Code. 2,200 plus companies have been admitted to insolvency. All the data is now flowing in. People are able to appreciate that somebody took a 200 crore loan from somebody, sent it to one company, sent it to another company, all of whom sharing the same address, but they have no common directors. But that still makes them all connected. They said, where did the money go? He says, I gave it to him, I gave it to him. And a lot of dormant kind of companies and balance sheets. In fact, I know people, they say, oh, we are signing this balance sheet. It's all static. I've got 50 crore asset, 50 crore liability. And the same balance sheet we copy paste over the years with only a small change in the bank balance. Today, you've come to a point where you need to examine, can my client give money and invest in some other company and not even get an AGM notice? Can I have a situation where I invest 30 crores in somebody, I've not received a single dividend, I don't have shares, I don't have market price of the shares, which is commensurate. I'm only saying, today when you look at a transaction, somewhere 10% rule out the fraud angle to that transaction. It's important. Of course, there is 143.12, but that's a very restricted scope section, but please be aware of it. And so these are some of the few insights. and go back to first principles. So I said two words: professional skepticism and common sense. The third thing I'd like to talk about is first principles. A lot of times we use all these very nice audit tools, AZL, all this gizmo, but I think the fundamentals of auditing ought to stay back. If it is a debtor, have I performed a test of subsequent realization? If it is a creditor, have I done a test of subsequent payment? If it's a share capital and I have a corporate shareholder in my client, have I gone to the MCA website at least once and seen whether he's genuinely a shareholder? Very small things. And I think time has come when we really need to sort of brace up, be excited about what we are doing, and just perform the tasks that we do exemplarily well. Thank you once again for this opportunity. And I'm sorry if I've just stepped up a little more. And it's over back to the organizers. But namaste and thank you very, very much for this opportunity.
Thank you very much, madam. Thank you very much for your words. Definitely, the words which you are just to us intimated us definitely useful for us in moving forward in our day-to-day practices. So I request Sarita Sharini madam, you want to address anything more?
So you may proceed.
Yeah. So
thank you once again, James sir. Thank you very much for giving us the chance to host this seminar from the Corporate Loss Committee. Within no time, we have went to ma'am only just 9 days before that start of this one. After finalizing the total this thing, ma'am has kind enough to sanction the same within no time. Just within 3 days, he has made all the formalities completed and made it possible. Thank you, ma'am. Thank you very much. Vijayawada branch really owes a lot to you. Thank you.
Okay, sir.
thank you, ma'am. Thank you, sir. So I'll take the privilege.
Are recorded, right? So you can also send it to us. We'll post it.
Definitely, ma'am.
So I take the privilege to introduce Chinnaswamy Ganeshan, sir. Sir started his practice as a chartered accountant in 1988. He was in personal practice till 2005. Then he joined as a director in Livelock and Lewis, a network firm of PwC, for 6 years as a partner, and in BSR & Co. LLP as a network firm of KPMG for 6 years in audit practice. He handled Indian and multinational clients in automotive, IT, BPOs, KPOs, telecom, industrial markets, consumer markets, healthcare, logistics, shipping company, oil and gas, plantation, banking, financial services, and insurance sector. He was the lead partner for many Indian and multinational companies and carried out audits, advisory on international financial reporting, taxation, due diligence, and other assured services. He is presently the senior partner and head of audit and assurance of Messrs. GSN and Associates LLP, Chartered Accountants firm in Chennai. It has 11 partners and around 120 team members. SAR specializes in financial reporting, company law matters, audit and taxation, and is a recipient of the Jewel of India Award for his role in financial services and Certificate of Excellence Award for his contribution in field of financial services by International Business Council. SAR has presented more than 1250 papers at various seminars, workshops, conferences, both in India and abroad. He has assisted 80 plus companies in Indian AS transition. SAR is closely associated with ICAI for past 20 years as a guest faculty for all the regions. SAR is also associated with many Chamber of Commerce, universities like University of Madras, Annamalai University, Loyola Institute of Business Administration, Madurai Kamaraju University, and Vivekananda College. SAR is also advisory on many boards of India and multinational companies and is presently an independent director in board of directors of Railtel Corporation of India Limited, a mini Ratna public sector undertaking under Ministry of Railways. He is presently a co-opted member of Board of Studies and Department of Commerce of Shiv Nadar University, University of Madras, and Tyagarajan College of Madurai. With this detailed elaboration, I ask Chinnaswamy sir to please take over the session and move forward.
Thank you, James sir, for the nice introduction. before I start, maybe my sincere thanks to the organizers, the Jason sir and the Vijayawada branch, and more especially to Sripriya ma'am for considering the idea of doing a 360-degree analysis of the annual report. I think at the end of this series of session, surely you will have a complete clarity of right from drafting the notice for the annual general meeting, director's report, financial statement, audit report, and all other related information. It's a very good initiative by the Corporate Laws Committee and Sri Premaram particularly. And as it was rightly mentioned by JSR sir, he actually followed very closely because I was running around for completing certain listed company audits. So I was not responded for a day. So immediate next morning, again, a reminder will come. So the credit should also go to JSR sir for doing the entire conceptualization of this particular program. And of course, the way in which the speakers have been lined up is also very great. So now, my position is a little difficult because one thing, the tone has been set by Sripriya ma'am in respect of the expectation from the chartered accountants when they are doing the attest function. And since I'm going to speak on the Schedule 3 and Schedule 2 to the Companies Act, to some extent, we will also discuss on the Nidhi companies as directed by the Company Law Committee. Why I said it is a little difficult is because two reasons. One, we are going to talk on the preparation of the financial statement by the management, and as an auditor, what are all the other things which we have to do. That's the first requirement. The second reason why I felt is some of the amendments which we may be discussing is directly connected with another session you have already completed on CARO 2020. So I should ensure that there is no repetition which is happening. That's the reason why I thought that I will not talk about even a reference to CARO 2020, but I will provide you some sort of insight by showing the illustrative template. Since we have already completed some 3 listed companies and 2 private limited companies where we do not have any guidance except the guidance provided by the institute or by means of the guidance note on Division 1, Division 2, and Division 3. I think that we have also learned over a period of time. First company, when we have done, we have used a certain format. Second company, we have improved it. Third company, the company has some expectation and the requirement as per law was having a different expectation. How to marry these 2 requirements and ensure that the compliance with the law has been taken care. So we also learned over a period of time and understand each and every intricacies. And that is what we are planning to share. On that basis, I have created a small template in Excel sheet on various amendments, all the amendments which we are having in Schedule 3, and for which what is the expectation from Schedule 3.1, what is the expectation or the reason behind this particular amendment, that's 2, and third, what is the guidance available in respect of, as mentioned by Sripriya, one is on your professional skepticism and another is on your common sense and coming to the technical interpretation of that particular situation. So I have prepared something. I have not shared the PPT as well as the Excel sheet to the organizers, which I will do after the end of this session because it may require a little bit of fine tuning. I will share it after the end of the session, which may be circulated to all. And having said that, only one caution or disclaimer which I have to make. This is based on what I understood. Right? This is based on what I understood and what I have experienced for the client situation. So if you are going to use that particular template for your client situation, please check the factual correctness of fitting into the correct template or correct disclosure or any other explanatory statement is required to be given. Okay, this is what I thought that we should look into, especially certain areas which I felt that there could be little bit of inconvenience for the client and for the auditors. Unfortunately, we have to deal with that. No other alternative on that. So I am giving certain suggestions which you may evaluate and use it for your particular requirement. Having said that, what I will do now is I will share my screen and then I will first go through the presentation, and wherever the presentation requires a discussion on the Excel sheet, we will go to the Excel sheet. I think the PPT is visible on your screen. So we are going to talk on two important matters. One is on Schedule 2. Schedule 2 is talking about depreciation, how to deal with the depreciation in the financial statement of a company. And secondly, we are going to discuss on Schedule 3, normal Schedule 3 requirement, it like a recap, and specifically on the amendment which has happened and what type of disclosure or presentation is required. Is there any intricacies arising out of that? That's the reason why I use the word insight into the practical issues rather than just talking about Schedule 2 and Schedule 3. There is a requirement to talk on Nidhi companies to some extent, and depending upon the time availability, I may make a detailed discussion or a smaller discussion. That's what the idea behind this particular session. Now, when we were talking about this session, first we will complete the easiest portion. It's like when we write our examination also, we will first select the easy questions or the questions which are known to us easily. We will complete that so that we will have ample time for discussion with Schedule 3 and the related amendments. So let me just move on this particular requirement where we will discuss on one aspect, basically on depreciation. Now, Schedule 2 to the Companies Act, when we are talking about, it is basically talking about the depreciation to be provided for, and what it gives to you is an useful life measurement based on which depreciation will be done. So let us just make it simple with some number game. So for example, if I'm saying that I have a plant and machinery of, say for example, I have a plant and machinery, say for example, if I have, I will select the colors. Okay. So if I'm talking about, I have a machinery which has been purchased for 100 rupees. I'm just giving a simple number. You can make it as 100 lakhs or you can make it 100,000, whatever number. So this 100 rupees which I have invested in my fixed asset has to go through my balance sheet. So I have to consider this as property, plant and equipment. We normally call that as tangible fixed asset. With the introduction of AS 10 revised, the term has been changed to property, plant and equipment. So we will talk about property, plant and equipment and how we will consider this particular adjustment. So 100 rupees is capitalized. We will pass a journal entry, debit plant and machinery, credit bank, assuming that we have purchased on paying the money from out of our internal cash account. Now the question comes is, since I have considered this as an asset, rather than charging that as an expenditure, but this asset is going to be used for manufacture of the end product or for doing a service which is my prime revenue stream. So for example, if I manufacture gears, and for this machinery, it is a gear cutting machine. So I'm not going to actually take revenue by this particular machine itself, but by using that machine, I'm going to generate a revenue stream. So because of that, it is not directly a revenue expenditure. The moment I say it is not a revenue expenditure, it goes and sits in my balance sheet under the head property, plant and equipment. But at the same time, this asset cannot be used for a number of years, right? It can be used only for a particular period of time up to which the machinery will be having a capability of generating or capability of producing the asset with the same quality which we were normally talking about, right? That is what we will talk about. That capability over a period of time is what we will talk about as useful life of the property, plant and equipment. The moment I say property, plant and equipment, it also talks about class of asset. For example, land is a class of asset, building is a class of asset, property, plant and machinery is a class of asset, office equipment is a class of asset. To put it in simple terms, you can simply consider that this is more or less equivalent to the block of asset. In the block of asset under Income Tax Act, because we will be more comfortable when we are talking about the Income Tax Act, under the block of asset model under Section 32 of the Income Tax Act, we go by the percentage of the depreciation which we will charge for the asset. Only difference here is we are not going by the percentage of depreciation, but going by the category of the asset. That is what class of asset. So property, plant and equipment is one of the class of asset. Now, the question which we are having is that how long I can use this? How long I can use this particular machinery? That is the useful life. So, for example, I may be using a machinery for 20 years, and you may be using the machinery only for 15 years, or some other company may be using it only for 10 years because they are going to use it over a period of the 10 years in 3 shifts, whereas I'm using only for 1 shift, and you are going to use it only for 2 shifts. There could be the usage which will create some sort of wear and tear. So this wear and tear will be captured for a fraction of time, that is passage of time, and for the usage. So we call that as a depreciation. To put it in simple terms, it is a depreciation. Now the question is, this depreciation is on 100 rupees or this depreciation should be on some other number? Here we are going by our AS 10 accounting standard on depreciation as well as Schedule 2. What these two standards, this standard and the schedule is talking about is there is a concept called depreciable amount. So depreciable amount is what? They are saying your cost, which is my 100 rupees, and you may sell it at the end of useful life as a scrap, or it may fetch what we call it as a residual value. So what is your residual value? They say normally 5%. So 5 is considered. The balance 95, because this 5 you will recover by selling the asset in the market at the end of the useful life. So it is not going to be your loss over the 10-year period or 20-year period, which is a useful life. So accordingly, only 95 is going to be your loss or the charge in respect of the usage of the asset over the economic useful life. So this 95 has to be accounted in your financial statement as depreciation on 2 possibilities. One is straight line method or WDV method. Straight line method is very simple. 95, say for example, we have concluded that this will have a 20 years of useful life. Say 20 years, which I am talking about. So it will be 4.75. 95 divided by 20 will give me 4.75 per year as a charge. Right from the first year to the end of the useful life, I will charge it till such time the asset is disposed. Okay, that is straight line method. WDV method is simple because we are very conversant with that method under the Income Tax Act. Original cost 100 minus residual value 5, 95. On 95, first year I estimated an useful life, and accordingly, say for example, that comes to a charge of 9.5. I will reduce 95 minus 9.5 on the balance second year depreciation, like that we will do. The problem in respect of WDV method under Schedule 2, I'm not talking about company Income Tax Act. Under Schedule 2, we have a problem because there is a formula by which you have to convert the useful life into a percentage. So that creates a problem. So I normally suggest for a smaller companies, majority of our discussion will be on smaller companies, which will be major clients of us, and maybe listed companies, one or two we will have, or bigger private limited companies also, very few we will have. So our discussion on the intricacies of issues relating to small companies, medium-sized companies, we will discuss, right? So my suggestion is better go for straight line method of depreciation. One problem which I have seen in my own life was, can I change the depreciation method if I have used WDV method to SLM method, straight line method? And in that case, whether I have to retrospectively recreate my depreciation. For example, when you use WDV method, you will charge depreciation on a higher rate, whereas in straight line method, it may be lower number. So in that case, when you are changing, you have to recompute your depreciation, whether you have to recompute your depreciation on straight line basis right from the first day of acquisition of the asset, and ensure that what is the WDV, difference between what is the WDV you are having, whether we have to credit or debit my P&L. In fact, we did this exercise when Schedule 2 came into the picture for the first time for some of the private limited companies where we have adopted WDV method. When we did this exercise, as per Schedule 2, you are supposed to calculate on a retrospective basis. When I did that exercise, what has happened was a sizable amount of depreciation becomes a reversal, and that has to be credited to the P&L account, and the credit resulted in a huge minimum alternate tax. Now only we have 115 BAA where we can adopt this and we need not have our minimum alternate tax. Whereas on the other side, at the time we had minimum alternate tax under section 115 JB. So we had a problem. So even though we done an exercise, we stopped adopting that particular work for a simple reason. It become a negative impact or negative incentive for the client from moving from WDV method to straight line method. And why we are discussing that now? With the change in the standard AS10, AS10 made it very, very clear a change in method of depreciation is not change in accounting policy. It is a change in accounting estimate. Meaning what? You need not do a retrospective recomputation. You can simply take the WDV on the opening date and see what is the remaining useful life. For example, on WDV, this asset, 100 rupees asset has come to say 65 on the fourth year. Let us assume that it's in the fourth year. Now, there are, maybe I can consider that as a fifth year because calculation will be easier for me. After 5 years, it becomes 65 rupees WDV or carrying amount. What I can simply do with the new one is that balance useful life is 5 years. So 65 divided by 5, which comes to 3.25 per year. On straight line, I can charge from the current year, I mean, from the 6th year to the 10th year. No recrediting. Old number has to be worked out and credited to P&L, which may have an impact on MAT. All these things are now ruled out. You can simply take the opening balance and see what is the remaining useful life. In my case, I'm assuming 10 years. So, here we have taken 20 years. Let us assume it's a 10 years. Balance useful life is 5 years. So 65 is being divided by 5, which is the remaining useful life, and 3.25 per annum is being charged on straight line method. No MAT impact. Okay. Now the question comes is, when we say useful life, whether the useful life given in Schedule 2 is to be followed in exact sense, or we can have a flexibility. That means, say for example, Schedule 2 says the indicative useful life in respect of a particular class of asset is 20 years. And you believe that you can change the asset once in 10 years. Can I change it to 10 years? That means I'm accelerating the depreciation. I'm charging higher depreciation according to my usage, my own industry. Can I do that, or I have to stick on to the useful life prescribed in Schedule 2? The answer is simple. It is only indicative. That means it is not rule. It is only an indication or an example which has been provided. Okay, you can use a higher number of years or lower number of years according to your facts and circumstances of the case. Only one requirement which we will discuss. If you are adopting different economic useful life, you have to give a justification in the notes and accounts. That is a very simple justification. Okay, this is what is the consideration on useful life. Indicative useful life is given. Now, what is my requirement on the next aspect is that this Schedule 2, whether I have to apply for all the industry or whether I have to apply for only certain industry. When I consider whether it is applying for certain industries or for all the industries, you have to be a little careful. This Schedule 2, when we are talking about, is always talks about specific exemption for certain industries. And these industries, I will tell you, it's a very simple logic. They are using the asset for doing certain services. For example, an electricity generation company and distribution company. The electricity tariff is dependent on the number of useful life which they are using, the cost of investment they have made. And accordingly, they have given a prescribed way in which depreciation should be amortized over the license period. That's the reason why they are excluding those industries. Now, we have the next question for us to understand is, this is what I have said. If companies are using different useful life, say instead of 20 years, I am using 10 years here, right? Whether the 10 years which I am using will be an exception, surely according to Schedule 2 is an exception. What Schedule 2 is expecting you is to explain why you believe that 10 years is required instead of 20 years. Then I will give you a justification by saying that based on, this is the normal words which we use, based on technical evaluation made by internal experts. Please understand the words which I am using. Based on technical evaluation made by internal experts, the company believes that the economic useful life of certain class of assets are different from the indicative useful life given in Schedule 2. This, in the opinion of the management, will result in relevant and reliable presentation of the financial statement. Relevant and reliable is what the user is looking for. For that purpose, you are giving a justification. And when I use the word technical evaluation, without technical evaluation, you cannot do a justification of a different economic useful life. The next question is, I use the word carried out by the internal experts. Now I am stopping for a moment. Whenever we are doing any assessment, whether external expert is required or external expert is not required. That's a question which we are having. As far as Schedule 2 is concerned, for making economic useful life assessment, the company's internal experts or internal project managers or maybe the factory managers will be enough for making the assessment. And this assessment which the company has made, you can also understand that this number or economic useful life from 20 years to 10 years, you can see from the past transaction. Even though they are adopting some economic useful life, as an auditor, you should also understand whether this economic useful life is representative for the company's operation. What we will normally do, how many years, once in how many years the company is actually changing its property, plant and equipment. Say for example, once in 10 years, could be possible. Another thing is, when the company is disposing its property, plant and equipment, or they book very huge profit on sale of fixed assets or very huge loss on sale of fixed assets. For example, I have 100 rupees worth of asset, maybe we will take it as 100 lakhs, and I have depreciated it over 20 years, and on the 10th year, I am disposing. 10th year, I am disposing. Maybe the anecdote will give me a better 10th year I am disposing. At this time, let us assume that since we are depreciating over the economic useful life of 20 years, I might have charged 5 lakhs per year as a depreciation. For 10 years, I might have charged 50 lakhs. So my carrying value on that period is 50 lakhs on the 10th year. Suppose if the company is purchasing a new asset on the 10th year and they are selling this particular asset and the asset is getting only 10 lakhs of sale value, right? 40 lakhs is loss on sale of asset, right? Loss on sale of asset. So that means what? Your depreciation charge or the economic useful life which we have assessed is not enough to capture the charge on an equal basis. You are booking the entire loss on the 11th year, whereas it should have been spread. Maybe in this case, instead of 20 years, it should have been 10 years. If you are talking about 10 years, or maybe you can talk about 12 years. So the 100 lakhs should be divided by that 10 years period. That means 100 minus for 5 years, 10 years is the period for which you are going to charge the depreciation, 10 lakhs per month. At the end of the 100th year, you might have charged 100 lakhs. I'm not considering any residual value because I assume that it will have only scrap value that is not equivalent to 5%, or otherwise it will be 95. A simple reason why I am using 100 is for calculation purposes. Okay, so if we do this, and if I sell 100 lakhs as a selling price at the end of the 10th year, this is profit on sale, right? This profit on sale is really representative of the scrap value of the asset, right? So the useful life which the company has made, whether it is correct or not, can be identified by what is the practice of company ending up with huge loss on sale of asset or huge profit on sale. Huge profit on sale means what? They are charging higher depreciation in the initial years itself, and their book value is 0. They are selling at some realizable price. So you have to avoid both, for which as an auditor, you have to exercise your judgment and see the past records and ensure that the economic useful life assessment made by the management using its internal experts, no requirement for using external expert, still it is acceptable. Okay, based on which you are supposed to give an explanation, right? Now, the next point which we have to consider is basically, okay, this anecdote gives me a problem. Because this my pen is using white color and anecdote gives me a problem. When I'm moving to the next screen, my pen will not take this over. But since it's taking over, I have to erase it. Maybe I will start using my white color pen, which will be little not visible clearly, but we will try to make it better. How I can do that. Okay. So now let us look at our next requirement of what we are considering. What we are considering here is, when we are talking about the useful life, the normal question which we are having is, what exactly is the useful life of an asset? See, for example, when you purchase an asset from the market, right? And the manufacturer says that this particular asset can be used for a minimum period of 20 years or 15 years or 10 years without any major change required, and the quality of your output will remain the same and the quantity of the output will also remain the same, subject to routine repairs and maintenance which is required to be done by the company. Okay, so that means manufacturers gives a guarantee that for so many years the asset can be used, whether that is the useful life. Manufacturer says once in 15 years the asset can be used, but the company changes once in 10 years because of their own internal calculation to the new asset. we ensure quality of the product output is being maintained. And when they are selling in the market, they are not booking very huge loss or booking very huge profit. So that shows that the wear and tear which the company has taken is considered to be correct of 10 years, not 20 years. So when they are making this assessment based on their usage, whether the management estimate has to be taken or the assurance given by the manufacturer has to be taken. This is a query which we are normally having. I have put that into some table format. Actual life of the asset according to the manufacturer is 15 years in both the cases. But in one case, the company wanted to replace the asset within 10 years because they will use excessive shift or maybe the product quality they wanted to maintain over a period of time. Another company is using it for 15 years as guaranteed by the manufacturer. What is the economic useful life to be considered as per Schedule 2? The answer is this is depending on company specific. This is based on company specific, and this is not based on what the manufacturer has given as a warranty. This is not the basis. We have to only go by what the company has made the assessment. Whatever company has made the assessment, that we have to take it into consideration. Okay, that is the economic useful life. Okay, I fixed an economic useful life. Whether that economic useful life has to be maintained at the same level or any change may be required, depending upon, say, for example, I'm using an asset on the understanding that I will use it for 15 years. And on the 12th year, I have found out that the technology itself is now more useful. So I have to discontinue this particular machinery and buy a new machinery. So on the 9th year, when I have anticipated that by 12th year, I'm going to suspend the usage, I have to revise my economic useful life that it is going to be only 12 years and not 15 years. So what will happen? I will charge accelerated depreciation on this particular item, and that accelerated depreciation will help me out in doing this entire exercise of analyzing this over a period of time. Okay. And this, the moment I have recomputed my depreciation and useful life, that is going to be only a change in estimate. That is not going to be a change in accounting policy, and accordingly, the adjustment is also required to be done only on what we call on a prospective basis, not on our retrospective basis. So the expectation is it should be evaluated at each reporting period. So every year the auditor should also check whether the usage of the asset is reasonable, or management is also prima facie has to do that work. Otherwise, auditor knows that impairment of asset has to be accounted for. This is on useful life. Now, let me go to the frequently asked question. Normally, I have this practice. Instead of opening the session for questions, whatever we have learned over a period of time and whatever may be in your mind as a question, we try to bring that questions into our discussion and learn from our experience over a period of time. Okay. So what I will do is I will complete the Schedule 2 discussion with all the frequently asked questions. Then I will see from your chat box if you are having any questions. I will assess, and if it is not answered, I will discuss those items as well. Now, what is our point? Whether change in useful life is a change in accounting policy or change in accounting estimate, I have made it very, very clear to you with the revised AS 10. This is only a change in accounting estimate. Accordingly, you have to do only prospective adjustment. You have to do only prospective adjustment and nothing to worry on MAT. So this is the biggest plus point of AS 10 revised read with Schedule 2. And accordingly, today, for all my companies, especially small private limited companies and mid-sized private limited companies, we have asked them to go for straight line method of depreciation. The validation for the client is simple. The validation for the auditor is simple. the accounting is also very, very simple. Otherwise, for every asset, you have to identify what is the WDV rate and then apply it. It's a very difficult process. So now I am changing it because there is no threat of PAT being there. Now, this is another question which is coming to us whenever we have this, especially if your client is a manufacturing company, the client may be working for single shift, double shift, or triple shift. Previously, there is one method where they are saying proportionate number of days it has been worked for extra shift. You have to calculate the extra shift allowance. And on that basis, the old schedule is schedule 14. It is actually given the rate which has to be adopted. Now that is removed. What they have simply said, if you are operating single shift, the indicative economic useful life given in schedule 2, please adopt. And at the same time, we are allowed to change the economic useful life provided you given a justification. And as I have discussed earlier, for a small and medium-sized private limited companies, I will not make any reassessment. I will simply go by schedule 2 because no requirement to talk about giving a justification, no requirement to talk about technical evaluation, no requirement to talk about the internal expert, whether it's relevant and reliable. Simply go with schedule 2 because it is a financial statement prepared for your client and for taxation purposes and not for any other big stakeholders are there. So for them, if you are adopting a particular method, that is fine. So I have concluded for majority of my clients only schedule 2 rates and that too on straight line method. You can follow that as a practical tip also. For extra shift, what I will do, if I am going to charge depreciation over 10-year period and I have identified that the current year charge is 10 lakh rupees, then 50% is added if I am operating single shift, double shift. So instead of 100 rupees, it will be 150 rupees. Suppose if I am going to use it for 3 shifts, it says 100% of normal depreciation, 100 plus 100, 200 lakhs, 200 is what he will charge. Very simple, no complication. Only thing which you have to see is that whether this extra shift depreciation is to be applied for the entire period or for the period for which it has been used during the year. Because if it is a normal depreciation, you are not adding anything. If it is double shift, you are adding 50%. If it is triple shift, you are adding 100%. So that means if you are not operating on extra shift, there is no reason to add anything. Why I am saying this is the moment a company is having extra shift depreciation, you have to be little cautious on the appropriateness of charging the depreciation. The reason which we have felt practically is that we were analyzing one particular company during the COVID-19 situation. We were analyzing the charge to the profit and loss account. For each of the expenditure type, we have analyzed as a percentage to the sales. When we analyzed as a percentage to the sales, the depreciation has increased significantly from 9% to 25% in a particular year. We were worried. What exactly is the mistake? Management is also not very clear what is the problem, but it's a COVID situation. They believe that because of COVID, their profits have come down. They are almost breaking even. But we felt that something is wrong. So the moment we have seen this, first question we have asked is, have you charged depreciation in the same method like in last year? They have said yes, because our fixed assets register is in Excel sheet, and the Excel sheet has given by projecting it for the next year, it gives what is the charge, and that is going to my P&L. Two problems here. One is the Excel spreadsheet being used to project my depreciation. That means whatever condition they have talked about in the previous year, it automatically assumes in the current year also. First problem, you have to see physically whether it is correct or not, or physically in sense, practically whether it's correct or not in the current year. COVID scenario, there could be some changes. So we have identified the first problem. The second problem is, as an auditor, you are supposed to check whether the depreciation charge is properly charged or not. We call that as a reperformance. In the audit technique, we call that as a reperformance. That means we recompute the depreciation independently and check whether it is matching with the client's number. Even for a private limited company, we used to do that. We have to do that because you cannot avoid doing it. Because you are mentioning that there is no material misstatement in the financial statement. In this particular scenario, from 9% it has gone to 28%. There is something unusual. When we inquired the client, they said that they are using an Excel spreadsheet. So we gone into the previous year where they were operating 3 shifts for the full year. Whereas in the subsequent year, due to COVID, where there is a complete lockdown, they could not operate the company for nearly 9 months. Only for 3 months they have operated. Now the question is, my depreciation should be 12 months or for 9 months. You know that depreciation for idle machinery cannot be avoided. You have to charge it for 12 months. So 12 months is the correct number. But the problem is, because the Excel spreadsheet has calculated extra shift allowance for 3 shifts in the previous year, if say, for example, my normal charge of depreciation is 20 lakhs, it's 20 lakhs. Now it is 100% is added, it's another 20 lakhs. So 40 lakhs is debited in the last year. Same method, the Excel has calculated 40 lakhs in the current year also. Whereas for 9 months, the company is not working at all. So there is no question of 3 shifts. There is no question of 2 shifts. In fact, they have not even worked. So normal depreciation only has to be charged for 9 months. For 3 months, extra shift allowance has to be charged only for 3 months. So instead of 20 lakhs, it has to be only 5 lakhs. So we have said that your depreciation charge should be only 25 lakhs and not 40 lakhs. When we have changed this number, as a percentage of expenditure, as a percentage of sale, this is more or less equivalent to that 9%. Which the company has budgeted in their internal MIS reporting. It's more or less same. So you have to only cautious about extra shift depreciation, whether the company has really worked on the extra shift. Another practical problem I have seen is that when we are considering normal shift, the company, because of their sales is increased, production has increased, they may be moving from normal shift to extra shift. So you should always, as an auditor, see, is there any major change in the production, major change in the sales volume? If so, how they have done that without new machine being added? Must be extra shift. So this is what we have started by saying your common sense. By analyzing the numbers, you can come to a conclusion that this is what is required to be taken into consideration. So extra shift also we have considered. Now, one more question which is normally coming in is, I have 20 years of economic useful life according to Schedule 2. Suppose if the management considers 40 years, then what happens? They are charging lower depreciation compared to what is given in Schedule 2. Instead of 20 years, I am spreading to 40 years. If instead of 40 years, I am using only 10 years, what happens? I charge twice of the minimum depreciation as per Schedule 2. I'm charging higher depreciation. When I'm charging higher depreciation or the economic useful life is lower, only when the economic useful life is lower than Schedule 2 rates, higher depreciation will come. Even in this case, whether I have to give the reason or justification, the answer is yes. Because they are simply saying, if you are not adopting the indicative economic useful life, you have to give a justification. You have to necessarily give. Normally, I have seen people are failing to give the justification where they believe that instead of 20 years, I have used 40 years, I have to give justification because I'm charging lower depreciation. Whereas I have reduce the economic useful life, so I'm charging higher depreciation. There is no need for me to give that explanation. The answer is wrong. You have to give justification in both the scenario. Okay. The additional aspect which is coming out of Schedule 2 is called component cost approach. What do you mean by component cost approach? Let us assume that one of the machinery is purchased at 80 lakhs. Okay. This 80 lakh machinery, let us assume that, simple example, I will take it as furnace in a production equipment. The furnace will have outer body and internal body. The internal body is what we call that as liners or heat resistant equipment will be inside. When you have the furnace at a very high temperature, the heat will be retained by using that internal layers, right? But what happens? This internal layer is continuously exposed for huge level of heat. So because of that, the particular item will be requiring a rechange. Say, for example, this outer body will withstand for 15 years. But this requires replacement in 5 years' time. If I depreciate the entire 8 lakhs minus the residual value over 15 years, I am making a wrong calculation, because one part of the asset, which is a significant part, which is the inside layer, will be replaced once in 5 years, and I will charge the entire expenditure as repairs and maintenance in the P&L account in the 5th year. So it is not correct. So what this AS 10 revised read with Schedule 2 says is that you should approach a component cost method. What do you mean by component cost method? The outer body is component 1 and my internal body is component 2. So component 1 economic useful life, UUL, is 15 years. For component 2, this is only 5 years. So I have to split that particular purchase value into 2 categories, component 1 and component 2. Component 2 will be depreciated over 5 years. Component 1 will be depreciated over 15 years. This concept is called component cost approach. The first question which we are having, is it mandatory? Is it mandatory? Or I can simply ignore. Is it optional? Unfortunately, yes, it is mandatory. So you cannot have a different style of charging depreciation. You have to necessarily charge depreciation based on component cost approach. There are some practical issues which may come out of that. Asset has to be split into 2 items, significant component. And second is, each component has to be depreciated based on its respective useful life. One is 15 years, another is 5 years. And in case if you are changing any old component, it is not a revenue expenditure. This is what is more important. In the books on the 5th year, I claim that as a revenue expenditure. In the, for income tax purposes, I charge it as a revenue expenditure. And books also I do it. But on the old item, I'm claiming over 15 years recovery, right? So this facility will not be available the moment you are going for a component cost approach. Unfortunately, your profit should be determined based on the Schedule 3 under the Companies Act. And to that extent, you have to go, one second. Sorry. So this is one thing which you have to be particularly careful, especially if the client is on the manufacturing side. If they are not in manufacturing side, you need not worry. And the other area where I have also seen that there could be a possibility of you having a problem is relating to electricity generation, like windmill, solar, shipping, this type of industry. When I'm talking about in Andhra Pradesh, that could be a possibility of shipping industries, maybe your client. So if there could be a possibility of you having a component cost approach coming in. Be careful on that, because Schedule 2 also requires that, and your AS 10 revised also requires that. No exemption for smaller and medium companies. Now, there are some frequently asked questions relating to this approach. Is it mandatory? I have mentioned that yes, it's mandatory. Whether all assets are to be componentized. This is where common sense comes in. If I have to split every asset, for example, if I'm talking about a mobile phone, and in the mobile phone I have a battery and I have a screen, whether that screen has to be separated and the battery has to be separated. I have a car, 4 tires are there, engine is there, seating arrangements are there, I have a battery, whether everything has to be split. It says significant component. Significant component. This is what it uses, significant component. And the significant component should have different economic useful life. So if it does not have a different economic useful life, then there is no question of splitting that. You can simply have it as this. So it is not required that everything has to be done. How to allocate cost is a challenge. When you purchase an asset, it comes as a single asset. How I can split the cost? Preferably ask the supplier himself what would be the replacement cost for this particular component. Use that as the basis for allocating it, or otherwise use the valuer to make an assessment and then split it. There are a lot of guidance which is available. So the new component which is replaced, previously that is coming under repairs and maintenance expenses. Now what I am supposed to do is old component is charged up, new component is capitalized, because that new component can be used for next 5 years. So to that extent, it becomes a capital asset for me. But for income tax purposes, there is no concept of component cost approach, because we go by ICDS, Income Computation and Disclosure Standard. There they are saying depreciation will be based on Section 32 of the Income Tax Act. Section 32. So Section 32 is not talking about component cost approach. Can I say whatever replacement which I have done is my revenue expenditure for income tax purposes? For book purposes, I will go with AS 10. Can I say? Still, you can say there are case laws which are available, but the problem is the assessing officer, the moment you are claiming something as revenue expenditure, having capitalized in the books of accounts, will question the appropriateness of that. Lower level, it will be very difficult. Higher level, maybe you will get it. For smaller companies, I may avoid doing that exercise. I will simply go with my normal method of considering that also as part of my chart. And whatever component which I have removed, I will consider that as a deletion from the block of asset. So that is another practical way of looking into that. Whether engaging experts is mandatory, no requirement. You yourself can do it if your team is capable of doing it. Okay. That brings us to the end of our discussion on Schedule 2. Now I will go to the chat box and see whether there are any specific questions which I have to consider. So let me just look at the questions which has come in. So a lot of points or only membership number has been mentioned. And there is one question which I saw. It is Satish Kumar is saying that can't change in depreciation method be considered as change in accounting policy? Satish, sir, I have already mentioned that because of revision in Schedule 2, this is considered as the point of change in accounting estimate and not change in accounting policy, you can go ahead. Murli Krishna is asking, how can you explain how you got 3.25, but I'm sorry, I'm not able to recollect it. The 3.25, which I might have calculated based on the remaining economic useful life on the WDV, on the date on which I am changing the economic useful life. So 5 years, I might have divided whatever was available on that. That I might have done. Maybe my arithmetical calculation may be wrong. The principle is very simple. The year in which you are changing the accounting estimate, you have to see what is the remaining economic useful life and what is the carrying amount. Carrying amount divided by remaining economic useful life will be the yearly charge. If my calculation arithmetically is wrong, please correct it with this concept. For change in WDV to SLM, whether retrospective effect is required, we have already discussed that it is not required. Naveen is asking an interesting question. A sugar industry operates 3 shifts, but operating days varies from 150 days to 200 days. How depreciation should be calculated? This is what is a difference between Schedule 2 and old schedule. Old schedule is talking about normal operating days. They are calculating some 270 days or something like that. If out of that so many days has been worked out, you have to charge depreciation for the full period, extra. Now it is proportionate to the number of days where they have operated. Because sugar industry being seasonal, crushing will happen based on the harvest which is available. So during that period, they will be operating for higher shift, and subsequently they will be operating for different shift. So the period where they have operated for higher shift, you charge extra shift elements. For the period they are not doing it, you can do that. Is depreciation chargeable during shutdown periods? It's Aranganathan is asking that question. Aranganathan sir, the answer is you have to consider twofold. One is extra shift depreciation will not be charged because you are not using it for extra shift. So that will be excluded. But whether normal depreciation should be avoided, you cannot avoid it, except in only one case which I have seen it. Because say for example, if your depreciation is based on unit of production method, in some manufacturing industry, they will have molds, dies, etc., where the molds will be used for making, say for example, 1 million component. Up to 1 million component, the mold can be used. It need not be thrown out. Suppose if you are during the shutdown period, you are not manufacturing anything, still it is capable of using it. The economic useful life is extended for the subsequent period also. So only where the depreciation is based on unit of production method, you can avoid depreciation for shutdown period. In all other cases, as rightly pointed out by Durga Prasad sir, depreciation has to be charged for a fraction of time, normal depreciation. Extra shift depreciation is not required to be charged. Okay. And I have a client in construction business. They have 20 tower cranes. Each crane costs 7 lakh USD. Client claims that 2 cranes could not be used at all for the last 1 year. So as the estimated life remains unchanged, can we allow depreciation for no depreciation for that particular item is okay. It is not specifically with any name. So this I have come across in my own case in respect of a company which has made very huge investment where they have considered on the capital asset, and some of the asset they are not actually able to get the orders, or the orders are very, very meager. So they were trying to say that, sorry, I am not going to charge depreciation on that. Unfortunately, the moment you have purchased, till such time the asset is going to be disposed of, you have a fraction of time. So there will be a normal depreciation which is calculated based on that. You have to necessarily charge. There is no question of postponing this particular item. There is one scenario where I have seen it is the residual value itself is equivalent to the cost of acquisition. Sometimes in some shipping industries, we have seen it. In that case, no depreciation has been charged for certain items. Could be possible because anyway you are going to recover it. Why should I charge? But having said that, Schedule 2 was talking about residual value will not be more than 5% is the assumption. If you are adopting something more than 5%, necessarily you have to explain in detail what is the justification for that. In the present case, I believe that client's claim of not charging depreciation cannot be accepted. Okay. And based on significant value of component only, you have to, okay. Joshi was mentioning that the pen is not visible because that gives in white. What I will do is anecdote where I will use it, but the problem is anecdote, every time I have to rub it, it will take a little bit of time. I will try to do that. Binod was asking is hotel building cost and interior cost, how to follow? First of all, very simple concept, sir. The building is one of the class of asset. Interior, we normally consider that as another class of asset. So naturally, they will be having two different economic useful life. And the problem with certain interiors which is affixed to the wall, that is not replaceable. In that case, what I have to do, necessarily component cost approach comes in. In fact, one of the examples they have given is an elevator installed in a hotel, and the building will be depreciated over 40 years period, but the elevator requires a replacement once in 20 years. Then depreciate that as a separate component. That is one of the examples which they are talking about. Whether earlier interpretation to consider useful life is maximum has underwent change by the amendment in Schedule 2. No, it is not like that, sir. It is actually, that is the reason why originally they have said that it's a minimum depreciation as per Schedule 2, but later on they have changed that the useful life given is indicative useful life by means of an explanation. So accordingly, this is only indication. Extra shift allowance normally will be based on that, John Matthew, sir. Okay, up to that we have answered all this question. Okay, then now next question is revised Schedule 2 applicable to all companies irrespective of the size? Anuradha is asking that question. Unfortunately, the answer is yes. Revised Schedule 6. If it is a private limited company, whether it's a small company, 1% company, Section 8 company, you cannot avoid Schedule 2. You have to go by Schedule 2, no other alternative. Unfortunately, the answer is you have to go by Schedule 2. It is applicable for all companies. That is the reason why I said, don't try to do a lot of research. Simply for smaller companies, it is only for specific needs of the shareholders, promoters, and for income tax filing. So whatever book depreciation is not going to be considered for income tax. So you are going to consider only the IT depreciation. Follow the indicative useful life given in Schedule 2. There ends the problem. That is what the practical way of looking into that. So that brings us to the Schedule 2 related discussion. So we are absolutely completed the Schedule 2. One more question. What if the company is operating for 3 shifts around the year, then double shift is applicable? The moment they are operating for 3 shifts around the year, then you have to apply depreciation based on 3 shifts. Suppose if they are, in my client case, what has happened was 9 months they have not operated because of shutdown. 3 months they have operated 3 shifts. So 3 months we have calculated extra shift at 3 shift basis. For the 9 months period, we have charged normal depreciation. Suppose if it is ulta, 6 months 2 shift and 6 months 3 shift. So proportionately, I will add the depreciation for extra shift elements. That's all. Very simple concept. Nothing more than that. It's a simple concept only. Okay. Whether any forms or anything need to be filed for the justification of the change in rate of depreciation, or where the justification is done. I think that I have already explained. When there is a justification, you have to give as part of the notes on accounts. What happens is there is a note on accounting policy. In the accounting policy, property, plant and equipment you will explain, and the depreciation and amortization you will explain. There you will say whether you are adopting Schedule 2 rates and what is the method, straight line method or WDV method. If you are adopting a different items, then you will explain for certain class of asset, the estimated useful life by the management is lower than or higher than what is prescribed, you can put a tabular column of saying what is the item, what is given in schedule 2, what the company has adopted, and that has been done by the technical evaluation using internal experts. In the opinion of the management, that will give you a relevant and reliable presentation. So in the notes on accounts, you will make that no form is required to be filed. Okay, the next question is, Naveen is asking this question. Is it mandatory to have extra ship depreciation or it's optional? Never ever it's optional. If you are using a particular item as extra ship, you have to mandatorily charge extra ship allowance. Okay, so the auditor has a duty to look into that. So that brings us to the discussion on schedule 2. Now we will move on to schedule 3. Suppose if you have further questions on schedule 2, you can still post it. I will take it up at the appropriate time, maybe after the end of this particular session. We will consider all these items. Okay. Now the question which we are having is that what is our reporting requirement of financial statement? First point which I wanted to tell you, whether you are a small company or big company, or you are a listed company or unlisted company, the reporting requirement has actually enhanced with the introduction of schedule 3. I believe that very strongly it is very extensively it is enhanced. That doesn't mean you have to have a fear, because every time I normally talk about any company law matters or auditing matter, the first point people are having a feeling is whether I should still retain my client as a company or I have to change it. First of all, please understand, it is requiring certain legal compliance. That's all. Nothing more than that. Why should we worry about it? Right? So, see, for example, we know pretty well after getting married, we will have problems, but still we have go to the extent of marrying and enjoying that marriage life. And we are not only doing this, we are also continue to do that for our children also. So we will be able to comply with the requirement of legal or social commitment which we are having. So make it as simple as that. Now, when we are having this, what are the changes? I told you that I will not make reference or discussion on CARO 2020, but I only wanted to mention that CARO 2020 has been amended. Certain new clauses has been added. Certain extended clauses are there. There are some certain subclasses. All these you might have learned in the session on CARO. Accordingly, I am not going into that. When CARO 2020 has been amended, only one question which come to us for the chartered accountants. When I am going to make a reference in my audit report, without management is committing on that particular item, is it correct? Is it beyond the financial statement? So, the representation was given by the institute that any change or any requirement in audit, there should be something in the financial statements. In other words, if you see even SA 700 on audit report says, if certain items are not appearing in the financial statement, then you can give only other matters paragraph. Then how I can give under legal and other regulatory matters as my audit report? Naturally, that item should be in the balance, in the financial statement. So if I have to bring in the financial statement, my existing schedule 3 requires an amendment. So they have done the amendment to align with that. Consequently, they have amended schedule 3. That is what we are going to discuss along with the other requirement of schedule 3. First thing which I wanted to tell you is that don't worry too much. People will talk about extensive disclosure is required. It will expose your client. Client will have this problem, that problem. First, to listen to me, that we have also done for 4 companies as of today. Out of that, 2 companies are listed companies, 2 companies are private limited companies. And the two companies, private limited companies, one company is a multinational company subsidiary, another is a normal Indian company. They also wanted to close it earlier. Last year it got delayed because their accountant was not ready. This year they wanted to put the pressure on the finance controller and they asked us to do the audit well in advance. We have completed that. In all the four cases, whether it's a listed company or multinational subsidiary or a normal private limited company, we have not seen any major issues in presentation and disclosure. We have seen there could be a possibility of certain, what I should use, side effect. And I'm taking a dose for my vaccination for COVID-19. There could be a side effect of I'm getting into fever or cough for 2 years, body pain for 2 days or 1 day. So when we are considering that side effect, we are believing that that side effect is required for ensuring that immunity is being brought in the body by means of vaccination. Same way consider, there could be a possible side effect. That possible side effect could be the practical issues which we may be having. How to handle that practical issue is our professional expertise. We are going to deal with that only. Okay. So don't worry about this change is a problem. No way it is a problem. It's a simple presentation. Create some side effect. We will see how the side effect can be minimized. Okay, bare minimum. So extensive presentation disclosure requirement, fine. That is what I was trying to say. This extensive presentation and disclosure, when I was reading Schedule 3 amendment and the guidance note, I was having a feeling that the presentation and disclosures are so wide. How we are going to get the information from the client? How we will make the client ready with the information? In fact, some of the auditors have gone overboard by saying, we will take a session or we will incur additional time to report on this particular item. And accordingly, well in advance, you have to prepare all this information. They have gone overboard is what my understanding. Initially, I also thought like that. But when we had a hands-on experience, we had a feeling that it's nothing to worry too much. Okay. All this information is available in some of the client cases where we are handling. For example, aging analysis. The client may not be having aging analysis readily available, but we can help them out to prepare an aging analysis because the volume of transactions will not be very high. Where the volume of transaction is very high, definitely the client will be having aging analysis. That's what we have seen out of our experience so far. In fact, we have issued a full-fledged audit report also under CARO 2020. Because one of the client on the listed company, they have signed off the financial statement, not one of the client, two clients were listed company client. On the date of signing, they have signed the full-fledged financial statement, including disclosure. Okay, it is not a question of only the numbers have been cleared. Annual report, when it is prepared, we will do the your audit report, etc. Not possible, right? Because of two reasons. One, on the date of signing, you should have your audit report ready. Second is UDIN cannot be generated backdated beyond 45 days. So you have that problem. So that means your audit report should also be ready. So we have completed. In fact, we are very comfortable having completed the entire work. Our headache for this year for that particular client is over. The only portion which is left out is your tax audit, for which we will allow the client to come out a little later because 26 days reconciliation is required, GST reconciliation is required for the purposes of ensuring the correctness. Now we have done on an estimated basis certain principles and moved on, right? So for filing, we may require more specific numbers, right? So because of that, we will take it up maybe in July or August, and then we will complete it. That's the way in which we have done it. Again, you can believe me that it is not something impracticable. It is possible. Maybe a little bit of extra effort is required. I'm using the word maybe little bit of extra effort, not even saying it's a complex situation. Only point which I have seen is that Schedule 3 disclosure and CARO 2020 comment has to be aligned properly. For example, one of the requirement is with respect to inventory. In inventory, there is no Schedule 3 requirement. Only in CARO 2020, whether there is a discrepancy of more than 10% in respect of each class of inventory, right? So how I will marry that requirement in Schedule 3? So we have requested the client, because I'm going to give that report. You can also confirm in your financial statement. We have requested the client, you can add an additional line item under your inventory note by saying physical verification has been carried out and no material discrepancy of 10% and above has been identified in respect of any of the item, any of the class of inventory. We have asked them to do it. Client was happy to do that because they have said that what you are reporting and what I am going to give in the financial statement are aligned properly. So there is nothing to worry too much on that. So you can help the client in doing that activity as well. Now, when we are talking about Schedule 3, the format of financial statement is our real concern. What is our real concern? One is, there are normal companies, they are not under Ind AS, they are not an NBFC company. So if it is an Ind AS company, separate set of accounting standards will be applicable. And if it is a NBFC, separate set of accounting standards will be applicable. If it is a normal company, separate set of accounting standards will be applicable. Similarly, the format of the financial statement also, where you are not adopting Ind AS, the format is different. Where you are adopting Ind AS, the format is different. Where you are an NBFC with Ind AS, the format is different. So three different categories. So normal companies, where they are on the normal accounting standard and not Ind AS. So 90% of our client will fall in this particular category. What we have to do is, we have to go with Schedule 3, Division 1. Accordingly, what is given in Schedule 3, Division 1, that format, the disclosure, the instructions for preparation, we have to apply. Similarly, the amendment to Schedule 3, what is relevant to Division 1 alone is required to be complied with. What is relevant for the purposes of Division 2 or Division 3, it is not applicable to you. So you have to stick on to Division 1. Second is normal companies which are adopting Ind AS. For them, Division 2, somebody is using scribbling or anecdote, please avoid doing it. Okay, so this is nothing but anecdote if I'm not wrong.
So no one has control, sir.
Huh?
I think no one has control. Right.
Okay. So now, when we were talking about the normal companies with Ind AS, Division 2, Schedule 3, it is talking about the format as per Ind AS requirement. And the amendments for Schedule 3 is also given specifically for Division 2. So you have to only look at Division 2. Similarly, if it is an NBFC with Ind AS, then you will have Division 3. So you have to first identify which is the format in which you are reporting. The language which has been used by Stripriya was, what is the applicable financial reporting framework? It is an accounting standard, Ind AS or Ind AS for NBFC, which is the framework which you are using. That is what, but I am using normal colloquial language for us to make it as simple as possible. So in this particular situation, we have separate amendment. The greatest of all which I have seen is that the guidance note of the institute, ICAI guidance note, they have given 3 guidance notes. And these 3 guidance notes, One is for division 1, another is for division 2, another is for division 3. So depending upon the conclusion which you have reached, which is going to be your client financial statement format, use that particular guidance. And again, I must tell you that the quality of the guidance note nowadays is very, very good because of complete deliberation is being made at appropriate level. Okay, there is one question Rakesh is asking. If NBFC without Ind AS, then what would be the reporting format? That is your schedule 1 for your division 1 format, because Ind AS is having a format of liquidity basis. For other than that, you do not have anything required. Okay. Any change in engagement letter for schedule 3 and CARO changes? Naturally, sir, where the moment you are going to have some disclosure being added according to law, you would like to have the client to represent or management representation confirming your understanding, confirming what you are practically putting it. Definitely there will be an amendment for the representation letter which is required to be obtained from the client. Thank you for reminding me that. Okay, let us understand what is new in all your schedule 3. First thing is all the divisions have been undergone change. Division 1 also undergone change, 2 also undergone change, 3 also undergone change. Okay, so that means we have to consider the client, which division is applicable, what is the amendment. That's the way in which we have to look into. This amendments shall apply for March 2022. What is the meaning of it? They are using the word accounting period commencing on or after 1/4/2021. So commencing period on or 1/4/2021 is what they were talking about. The moment I say it's 2021, suppose if the client has started from April 2021, I don't have a problem. 31st March will be my year end, and I have to look at as part of the disclosure which I am supposed to give, right? Suppose if I'm talking about a scenario where the company is using a different accounting period, that could be a possibility. For example, the parent company is in some foreign country and you are a subsidiary here. Parent company uses December as the year end. In that particular situation, your current period, that is December 21, might have started from 1/1/2022 and it ends with 1/1/2021 ends with 31st December 2021. So the accounting period is not commencing on or after 1/4/2021. So for the current period, no change is required. For the next year, that is for the year ending December 31st December 2022, you are supposed to give all the disclosure according to amendment. But having said that, it is only for academic interest. Practically, I have seen 99.99% of the companies which I have audited, you have audited, we are aligned the year end only to 31st March. And accordingly, for the current period, we can say that the amendments are applicable. Very simple way in which we can conclude. Now, why this amendment? We have already had this mainly because auditor is supposed to make some comment, whether that comment is appearing in the financial statement or not. That we have done. Now, what is this amendment? Whether it requires any new law to be applied or new accounting standard to be applied, or it is only something relating to, maybe whether it is requiring any adjustment in the balance sheet and P&L, or it is only a presentation and disclosure. Because if it's a presentation and disclosure, we need not worry because our audit procedure will be normal. Only a additional presentation and disclosure, you have to do certain extra activity to get the details ready for that purpose. So it is mainly affecting presentation and disclosure. That means no journal entry is required to be adjusted in the balance sheet or P&L or even in the cash flow statement. maybe one additional line item required in the main balance sheet. Maybe some 2-3 additional notes has to be added in the notes and accounts. And then you have to explain that particular item in other notes. That is what we are talking about, presentation and disclosure. Nothing to do with passing accounting or auditing journal entries. Okay. Next is only problem which people are worried about is it may result. I'm cautiously using the word may result, but people used to say this will create a big problem. May result. If you consider that it may result in opening the Pandora box, how to handle that situation? As a professional, we have to handle, right? Because the amendment is coming on 31st March, effective from 1st of April. We are ready to do that. New circular is coming in, which says that 4 additional clauses in the audit report to be added. We are familiar with that. One client is asking even before Infosys or the other companies have published full annual report, the entire financial statement to be signed off. We agreed and we are using our expertise. We are finding a solution for that. So it may result in opening of the Pandora box. If so, what should be our practical solution for it? Because auditors are expected to be a solution provider rather than problem creator, right? If there is a problem, what is the solution? And of course, solution is within the 4 walls of law, not beyond that. That means it's not solution, it is an adjustment. I'm not talking about adjustment, I'm talking about solution, right? So now, what type of issues which may arise? Okay, one question in between has come. Is it require change in reporting for the previous year figures? Very interesting question came. When I am changing the presentation and disclosure in the current period, whether the comparative number should also be changed or not to be changed. The interesting point in the guidance is previous year also should be restated or reclassified to corresponding to the current year classification. In fact, the illustrative disclosure, I have also added a note to be given as the last note for the financial statement. Because we are reclassifying certain items to align with the Schedule 3 amendments. I also mentioned that because of this amendment, last year we have shown this here, this year we are showing it here. And to that extent, there is a change. Okay, that is only for aligning with the requirement of Schedule 3 amendment. Yes, you have to reclassify the previous year figures as well. Durga Professor has already answered that question as yes. If a company is under liquidation, whose financial statements are yet to be prepared, and March 21 financial statements are yet to be prepared, then whether they need to follow the revised Schedule 3, the answer is no. Because Samir, the answer why I am giving as a no is for the benefit of all. Your date of audit report is not the basis. The accounting period commencing on or after 1/4/2021 is applicable. So in respect of a company which is under liquidation or maybe under litigation, they are not able to prepare. One new appointment which we have received is there was a litigation between the joint venture partner. Because of that, 2018 was audited by an audit firm and they have given a disclaimer of opinion in July 2021. Just imagine, 2018 has been audited and they have given a disclaimer of opinion in July 2021. 19 March, 20 March, 21 March. 3 years were pending at that point time itself. 22 is now added. Now, when we have engaged for helping them out in that particular audit, we are trying to find out certain solutions within the available framework, how that disclaimer can be converted into a qualification rather than maintaining the disclaimer. We have identified certain reasoning by which it can be done. And again, we are going to do the audit for 19 March, 20 March, 21 March. Those financial statements are not having accounting period commencing on or after 1st April 2021. Our audit opinion will be given in the current date. That will be according to old Schedule 3. The amendments are not required to be incorporated for 19 March, 20 March, 21 March. Only for 22 March, all these amendments will be incorporated, right? I think it makes very clear about your question on liquidation company. I have a litigated company where I have 3 years to be taken care. Now, what are all the major changes in respect of the amendment? After the major changes and the discussion, what I will do is I will open the Excel file, illustrative format, and take you through like a walkthrough of the entire amendment, where you have to put that note. What is the illustrative template which you can use? What is the language you may use? All those things I have given in that format. You can amend it as according to your client situation. So we will go through that. Before that, we should understand what are all the major changes. The first thing is, this is not relating to what I should say, your disclosure, but this is relating to presentation. What is a presentation? This may result in a little bit of extra time to be spent on each of our clients. Even for smaller clients, this nonsense comes in. Why I call that as a nonsense is, our income tax return is filed with full figures, right? And for all our tax audit and other things, we are using electronic form with full figures. And your XML for ROCs also comes with full figures. But financial statement has to be rounded off mandatorily as per Schedule 3. Previously, it was an option. Now they have made it as mandatory. How it becomes mandatory? By shifting only one single word. What they have said is, the client may round off the figures in the financial statement. If round off is elected, this has to be followed. That was old Schedule 3. The may has been replaced. The client shall present the financial statement with rounded off in accordance with the table provided below. That means it is a mandatory, simple word change, but it becomes a additional work. But what we have suggested the client is, anyway, you are preparing the financial statement in Excel format for full figures. Excel comes out with a simple formula, round off. So keep that 2 columns with our full figures, and then add 2 more columns which are with the rounded off figures. And with the rounded off figures, you arrive at by is equal to round off that number divided by whether you are going to give on lakhs or thousands or millions, depending upon that. Make it a round off. Copy that formula to all the line items in your notes and accounts, all the line items in your balance sheet, all the line items in your P&L. Automatically you will get that number, right? So it is only one time setting of the work or setup work which the client has to do. In fact, some of the clients have gone with their smart accountants, and even our article students have find out some method. They have said that it can be used by means of what we call as macros. The moment you put some numbers, full number, in this column, it has to come like this. So you can set a macro also, but for a smaller company, don't go into that complex situation. In fact, in some of my client cases, I have seen client has the company name in a separate sheet, and the company name, wherever it is required, they have called that particular sheet. I told them, boss, even if I am preparing the financial statement for my client, there is a meaning of using this formula, because I may be using for X client and then Y client and Z client. So for X client, I use X, automatically everywhere it shows X. For another client, the same format Y I put, everywhere Y is available. That is fine. For you, it's the same company. Why should you have all this complexity? So make life easier. That's what I have seen in Excel. Too much of formulas will be a problem for us also to understand. Make it simple. So what I have suggested the client is, have your full financial statement ready with full figures. Insert 2 more columns on the face of the balance sheet, on the face of the P&L, on the notes and accounts. and with respect to all the disclosures which you are going to give in figures. And then in the notes on accounts, even on not on the face of the balance sheet or face of the P&L, you have to do the round off. In the notes on accounts, when you have done the round off, you can have all the numbers properly here. That is one way of doing it. Another way of doing it, which I have seen in certain clients where they have the trial balance imported and the trial balance is linked with the financial statement using what we call as the formula if condition. They use an if condition. They sum if, yeah, it's a sum if. Sum if based on a particular line item which is appearing in the trial balance and the grouping which is appearing in the trial balance. For the group, they summarize the entire thing and put this figure. What I have suggested is in the trial balance itself have the two columns, and instead of using the column relating to full number, use the column relating to the other number. And for your income tax purposes, use the other column. You can use that also, whatever way in which you can do it. What is the rounding off? We will come to that a little later, but you have to mandatorily round off the figures in the financial statement, either to thousands or lakhs or millions or crores. You have to round it off. It's a mandatory for even smaller companies. That's the first requirement. Another small change which has come on the face of the balance sheet. We will show the asset as tangible fixed assets, intangible assets. Now the tangible asset is changed to property, plant and equipment. The moment I change property, plant and equipment, please cautious that this property, plant and equipment appears in a lot of places. One, your note on fixed assets, where you will show gross cost and additions during the year, disposal during the year, then cumulative depreciation, current year depreciation, disposal, depreciation withdrawn on disposal, closing carrying amount. There also you use the word tangible fixed asset. In accounting policy, you will normally talk about how you are capitalizing a particular item. There also you use a fixed asset. In depreciation policy also you use a fixed asset. Please ensure that in all the places, the tangible assets are replaced with property, plant and equipment. I need not tell you, find and replace is the simplest way, but find, replace, all don't click. One by one, you do it. Sometimes there may be a wrong reference, which also get replaced by property, plant, equipment. Okay, so you have to be cautious, and all the places you have to uniformly use this word. And this is one thing is interesting, which is coming in. In the share capital, we normally give a lot of things. Authorized capital, issued capital, subscribed capital, and then what is the movement in the number of shares, what are the shares held by the parent company, associate companies, etc. And what is the details of shareholders holding more than 5% individually. So that also we will disclose. Additionally, they are asking for one more disclosure. What is the shares held by the promoters? And is there any change compared to the previous year? If so, what is the percentage of change? That is what they are requiring. For private limited companies, 90 to 99%, there will not be any change in the previous year and current year. It will be only a presentation of showing no change. That's all. Now, another interesting change which has happened is I have taken a long-term loan. And out of the long-term loan, say assuming that it's going to be repaid over 10-year period. Out of that long-term loan, 10-year period, when they have given the repayment thing, what I'm going to repay within the next 1 year, we call that as current maturities of long-term borrowings, right? That current maturities of long-term borrowings, we are used to show under current liabilities, other current liabilities, under which first item it will be current maturities of long-term borrowings. And we will give a cross reference to the long-term borrowings note. Okay. Now what they are saying is, it is not a liability. It is also a borrowing from the bank. By putting that under other current liabilities, you are not showing the borrowings properly. And accordingly, we should know the entire borrowing. So what is going to be repaid within the next 1 year, you show that as short-term borrowing. What is going to be repaid after 12 months, you show that as long-term borrowing. So what I have suggested for many of my clients is show the entire long-term borrowings as one single line item on the face of the note relating to long-term borrowing. And then say less current maturities of long-term borrowings shown under short-term borrowings. Refer note so and so. That refer note is nothing but short-term borrowing note. And put the number. And in short-term borrowings, current maturities of long-term borrowings, link this number to that number which is given in note to long-term borrowing. And give the cross-reference of long-term borrowing. Simple method. Somebody has asked whether I have to restate the previous year figures also. Here exactly the problem will come. If I'm doing only the current year adjustment for short-term borrowings, previous year number will be 0. That number will be shown as part of my current liability. Current liability will show a very high figure for the previous year, whereas short-term borrowing will show a high figure in the current period. People will be confused. So you have to restate the previous year number also from current liabilities to short-term borrowings. That is the reason why I said, yes, it requires a restatement or reclassification for the current period. Okay. There are some questions which has come in. Who will fall? VLOOKUP is another method which we can use, Rinko, and people are using even SUMIF method also. Both are will give the same result. So whatever is easy, you can actually do that. Rakesh is asking whether the Excel sheet file will be shared. Yes, at the end of the session, I will definitely share this presentation as well as the other one, which you can amend. Again, I'm coming back to that. Amend it according to your client situation. I have a policy in my office, proud to copy. Proud to copy means is what? We believe that what I have already prepared over a period of time, the new article student come into the picture or new person who has joined as a team member need not recreate or unveil the wheel. So they can simply use, they need not reinvent the wheel. They can simply use what we have already used to test it, right? So in that case, they can proud to copy. But when proud to copy, we have told them the next point is but verify. So that means if a client is on doing a retail business and the format has been copied and pasted from a company which is manufacturing, the language which we have to use may be different. So please edit that alone, which is important from your side. Who will fall under promoters in respect of private limited company? The point you were talking about, I will take it up a little later when we were talking about the promoters' share capital, and we were discussing that. I will do that. Is there a material change in promoter holding post balance sheet date, whether reporting is required? Fortunately, Joshi, that is not actually asked. Because if we are going into that, we will not be able to complete the current year audit. We will also be talking about something else. Nidhi company, we will come to that later, boss. So we have to complete this. That is a major task, and then we will come to that. Now, coming into this aging schedule of certain items in the balance sheet. For example, there are aging schedule which has to be given as part of the note. One is trade receivable, trade payable, capital work in progress, intangibles under development, even unbilled revenue. They are asking for aging analysis. This aging analysis, to my mind, may pose some certain challenges, which may create some problem under the Income Tax Act also, or maybe when the regulators are reviewing the financial statement, or even in the audit committee, there could be some disturbing questions which may come. We will see where that problem will come and how we can handle that. Now, there is one line item which has been specifically asked to be incorporated. Under other non-current asset, they are asking you to incorporate security deposit separately. For example, rental deposit, etc., we might have added to advances recoverable in cash or kind or value to be received. Now they are asking you to show that security deposit separately. Security deposit includes even rental deposits. That is also considered as a security deposit, electricity deposit, whatever, even telephone deposit. All those things are security deposit, which you are supposed to show as a separate line item in the notes relating to other non-current asset. Okay, I think it's a copy paste. Purpose for which borrowing from banks has been used. So this is one requirement which says whether the loans taken from the banks and financial institutions, or they are using the word borrowings from banks and financial institutions, are being used for the purpose for which it is raised. That is one of the requirement in the audit report, for which I am suggesting to include that commitment from the bank instead of only going for your management representation letter. Better to incorporate there itself whether they have applied for the purpose for which it has been raised. So you can do that. Now coming to the mandatory rounding off. What is mandatory rounding off? Two changes which has happened. One is previously there is no requirement to round off. We can use the full figures. Now that option has been eliminated. First thing. Second was they are doing the rounding off based on one guidance given in a tabular form, 100 crore, less than 100 crore. That's the way in which they have taken that number. On that basis, they were having the parameter, what is less than 100 crore? They talked about turnover less than 100 crore. Now, instead of turnover, they are using total income. That means total income includes your turnover, other operating revenue, other income as well. That is the second change which has happened. What is the requirement? If the total income is less than 100 crore, the financial statements has to be rounded off to the either to nearest 100, either to nearest 100 or to thousands or lakhs or millions or decimals. Only item which is missed out is crores is missed out. All other items are included. Now there are two things which we have to see. Nearest 1,000 is possible, 100 possible, 1,000 possible, lakhs possible, millions possible, decimals thereof. That is coming with R. That means you need not even give the decimals. You can give the full figures rounded off to nearest to, when you use the round off formula, comma 0, if you put that, it will be rounded up to the nearest number without any decimal. So you can do that with decimal or without decimal, but you have to mandatorily do that rounding off. So the parameter is, if the total income is 100, less than 100 crore, you have to do it. Majority of our client will be under this category. And making nearest to hundreds, nearest to thousands, lakhs or millions, you have to depend on what is the size of the company. In some cases, if you are trying to give lakhs, the lakhs will be 0.001. That means it becomes 0. So the majority of the numbers may be below that level. So you have to decide based on whether thousands is a better choice. In my personal view, I never prefer hundreds. I never prefer millions because this will confuse us. Thousands is easier because after the decimal, we know 3 triple zeros has to come in. So lakhs can be identified by easily putting after 2 digits. If I put that, it is lakhs, I can convert that. So thousands or lakhs will be a better choice according to my understanding, but you can decide whatever you want. Suppose if it is more than 100 crore, hundreds is not possible, thousands is not possible, lakhs is possible, million is possible, crores is possible. In this case also, I have seen that lakhs is what majority of the companies are using. Very big listed companies are using crores. millions, very few companies, millions are being used. Because millions, again, you have to convert that into lakhs for your understanding, or crores into for your understanding, right? So that is what is required, right? Now, having done this, we have to understand what are all the other possible questions. Whether I have to give full figures, I cannot give. So it is ruled out now. What is meant by total income? I have told that your turnover as well as income has to be added together. One problem is, this is what you have to be careful. I have seen even FRRB has commented in many cases this particular issue being adopted by some of the companies. What happens is, in the balance sheet, profit and loss, cash flow statement, they will and notes, they will use rounded off number. But in the notes and accounts, where narrative comes in, they are using the full figures. But what we are saying, different units of measurement cannot be used. You have to use the same measurement in all the cases, is what has been given by the standard and by this amendment. And accordingly, you cannot have round off in the financial statement and full figures in your notes and accounts. Everything should be aligned in the same manner. Okay, that is one thing which you have to keep it in your mind. Now, in respect of small companies, can I put in rupees? No. Rupees should be thousands of rupees or hundreds of rupees or lakhs of rupees. You cannot put it in full figures. Not outing rupees in lakhs. It is not at all possible. That is what I'm saying. It's mandatory that you have to do a rounding off. It means every company has to do it. So we have to prepare two financials with rounding off and without rounding off. I think that Prasanna, you have joined little late, or you have missed out what I have explained already. And I have told, when we are discussing this, I told we are not going to prepare. Client is going to prepare. Right? First of all, keep that very clear, because you are only an auditor. Client prepares that, and client prepares the financial statement with full figures. You ask them to add two more columns. Use that column for rounding off. Automatically it is there. There is no two sets of financial statement. When you sign off as an auditor or the management, you will be signing off the rounded off figures. Okay. Ananta was making that, though it is applicable from 1/4/2021, it's good applicable from 1/4/2020, since we need to rearrange the previous year figures. In fact, one of my company has done this, Ananta. They have done it for last year itself. But when the problem of last year has happened, they have to rearrange the previous year figures of 21. They have done it. So 20 number also they have rearranged it. Okay. Anyway, the problem will come. One way or other, reclassification will happen in first year. For a small company, don't try to venture for the early adoption. Better go for the current number. So that is what I have considered as the better way of doing it. Okay. Now, whether decimals are only optional. Yeah, only decimals are optional, because they have made it simple with the usage of word R. Whether unit of measurement of rounding off requires to be specified in accounting policy. Asim Rai, we use that as a presentation currency under Ind AS. For a normal company, we don't do that. So you can decide what you wanted to do it. If you wanted to define that, the financial statements have been presented in INR, rounded off to the nearest 1,000 or rounded off to the nearest thing, you can give it on. Or normally what I follow is that on the top of the balance sheet, where we are saying company name first and balance sheet asset March 31st, 2022. Next line, we are asking the client to incorporate all amounts are presented in INR, rupees lakhs or rupees thousands, unless otherwise stated. We are making it. For example, the number of shares you will not state at in thousands or lakhs. So unless otherwise stated, and some people used to say, other than shared data, they are also specifically mentioning which is not given. So you can decide what you wanted to have it. So that is also left to you. Okay. Now we will go to the next discussion on this. Some of the illustrative disclosure. So this illustrative disclosure, for that purpose, I am going to open my Excel sheet. Okay. Just tell me that this Excel sheet is visible on your screen. Maybe the font size may be little not visible. Whether this is visible on your screen? Yes, visible. So before I go into that, there is one more question which has already come. That question is relating to what? Can we use the same financial reports rounded off as reported under the company law by reporting tax audit report which contains full figures? I have my own doubt, Satish Kumar, because your e-returns will not accept this number. So your tax is being calculated on the number, and how you will be able to make your balance tax or your 234A, B, C interest, etc. I have my own doubt. That is the reason why for taxation purposes, it will be with the full figures. Even for ROC XBRL format, they have not yet changed the format. Maybe they will amend it to accept lakhs and thousands also. That may happen. But for the time being, for income tax, we have to necessarily have the full figures. Even for tax audit, we have to have the full figures. Now, I'm taking all the amendments in one go, but I'm placing it in the order in which they appear in the balance sheet, and order in which it appears in the financial statement, and order in which it appears in the notes and accounts. Let us understand this property, plant and equipment. In property, plant and equipment, we have, first thing which I have told you is that you cannot use the word tangible fixed asset. You have to make it as property, plant and equipment on the face of the balance sheet in all your notes and accounts, including the note relating to the movement in cost and accumulated depreciation. Wherever it appears, you have to use the property, plant and equipment. Now, with respect to this property, plant and equipment, one of the requirement in CARO 2020 is to comment on whether the title deeds of the company are with the company or not with the company. Okay. So the guidance note suggests that ask the client to incorporate that in the note relating to property, plant and equipment itself. So I have suggested note. One note says the title deeds comprising all the immovable properties of land and buildings which are freehold or held in the name of the company as at the balance sheet date. In respect of immovable properties of land and buildings that have been taken on lease and disclosed as fixed assets in the financial statement, the lease agreements are in the name of the company. So here also I am using this word as fixed assets, not as tangible asset. So leased asset has been taken as asset and disclosed as part of the fixed assets itself. And in that case, whether the lease agreements is in the name of the company. Okay. So suppose if it is not in the name of the company, what is the alternative you can use? I have given the option also. This is where I said it's like a template which you can use depending upon your client situation, which is the better way of presenting. So assuming that the company has been formed by taking over a partnership firm. The original investments in land and buildings were in the name of the partnership firm. It is not yet changed in the revenue records. So it is not in the name of the company. Naturally, you have to comment on that. So in that case, the requirement is the title deeds comprising the immovable properties of land and buildings which are freehold or held in the name of the company as at the balance sheet date, except the following. So what are all the items which are not there? Here, I have given property, plant and equipment, investment property, property, plant and equipment, retired from active use and held for disposal, others. I just wanted to tell you, when I prepare a template, I prepare the template looking into all the aspects of the disclosure. For example, there is no concept of investment property being disclosed separately for Schedule 1 company. Sorry, Division 1 companies, normal companies. That also goes as part of property, plant and equipment. In that case, remove this column, use only property, plant and equipment. If you are under Ind AS 40, you have to show investment property separately. Then take that also as a separate disclosure, right? And then there is a possibility that there are land and buildings which you have decided to sell off in the near future, not going to be used, retired from active use and being held for sale. In that case, even under our normal accounting standard, you are supposed to show that under current asset. Okay. And in AS, there is a separate standard, Ind AS 105, non-current asset held for sale and disposal, discontinuing operation. There is a separate one which is there. So here, as per AS 10 itself, we will show that. So this will also come into the picture. Others is other than land and buildings, land and buildings which are not falling into any of the other categories, maybe a leased asset. We will talk about that. Okay, now please see, this is a requirement which has to be mentioned according to Schedule 3. What they are saying is, in case if it is not held in the name of the company, you have to talk about what is the relevant item in the balance sheet, what is the description of the property, what is the gross carrying amount, whether held in the name of, in whose name, held in the name of, say, ABC, Mr. ABC, or Mr. X, Mr. Y, Mrs. Y, whatever, you have to give the name. Whether that person is promoter, director, or relative, or employee of the company. Here starts your problem. In some of the private companies, I have seen this. For sentimental reasons, the assets are purchased in the name of the director, or maybe the promoter or the shareholder, right? Or maybe even their relative, and it is accounted as property of the company. You may be claiming depreciation also on those items. Now, a new problem may come. Income tax department will ask the question, building is in the name of an individual, how the company can get the depreciation for tax purposes? Could be a possibility. Now you have to demonstrate this is a problem and what is the solution. You have to keep your records ready in case if you are holding any assets like that. You have to make it very clear that this is purchased out of the funds of the company and not recorded as an asset in the personal books of the promoter, and it is being used by the company. Purchased out of the funds in the name of the director, and director is using it as his residence. Not possible. You have to be careful whether it is used for the business of the company. And in that case, even if the income tax officer is making a different thing, we can demonstrate that it is actually used for the company's business, purchased out of that. Consistently, that is being done right from the beginning. This is the only reason. It is not for giving him any other benefit for the promoter or director, etc. And interestingly, what it says that, suppose if you are holding in the name of some other person, what is the period for which you are holding that? What is the period for which you are holding that particular item? Also, it is there. Say, for example, 5 years, 2 years, 6 months, temporary gap. And then you have to explain what is the reason. Then it says whether because of dispute it is outstanding. This is a normal scenario. I might have purchased a property, but I could not get it registered in the name of the company. Then in the case you mentioned that because of dispute. So this is to be given in the notes relating to property, plant and equipment. Then comes in respect of items which has been purchased or which are given based on a term loan taken or working capital loan taken, where you have given that as a collateral security. Naturally, the auditor could not verify the title deeds. In that case, the auditor will normally ask you to present the particular item as what you call as a confirmation from the bank. Based on that, we are disclosing that. The next requirement is whether the company has revalued the property, plant, equipment during the year. And if so, whether the revaluation is increased the asset by more than 10%. In that case, whether a registered valuer has been used. All these things are coming as part of your requirement of CARO 2020. So that also part of this. Here I have mentioned India 16 property, plant, equipment. You can change it to AS10 for a other company. And you can say that the company has done it and nothing is more than 10%. If it is more than 10%, you can give what are all the items where there is more than 10% revalued number. So I have tried to capture what are all the possibilities which will be available or in a client scenario. One size may not suit the other client size, but we can have a different size available on our hangers. So that is the way in which we have done it. So that is what we have talked about. Some cases, no registered valuer is used. Some cases, registered valuer is used. You capture all that information. Okay. Now, what if the asset being land was transferred to company for shares allotted to the directors using fair market value, but registration is pending? So, a difference between property and the investment property is very simple. Property is used for the company's business, whereas investment property is for renting to others or for capital appreciation. That is a difference. Whether consolidating entity may specify common unit of measurement for figures for subsidiaries, joint ventures, and associate. Sir, when you are preparing a consolidated financial statement, again you are preparing as per Schedule 3. So naturally, you have to talk about what is the unit of measurement which you have used. If the subsidiary has used a different thing, you have to convert according to what you are presenting for your standalone and consolidated. So it is not very major issue, sir. The next question is, what if the asset was transferred to company for shares allotted to directors at fair market value, but registration is pending? This is what I am trying to say. When there is a valid reason, you are purchasing the item from the directors and the process of registration is going on. In the reasons column, you explain the registration has happened on so and so date, but registration is pending to be done. Here, reason for not holding in the name of the company, you will explain all this reason. Okay. And you can also say that the period held was very early, only from the date of registration, it was held in the name of the director. Before that, it is not recorded in your asset, balance sheet as an asset. So like that, you can actually look into that. So genuine cases will not have a problem. If there is an ingenuine cases or there is something which has been done beyond the financial statement, that may get exposed off. Hopefully, I believe that we will not get into that type of financial statement sign off. Only one problem which I have repeatedly seen is items like car, which has been purchased in the name of the directors, and we get into some problem in one of the assessment after that. Maybe for the past 20-25 years of my practice, one of the audit procedure in property, plant, equipment, if there is an addition to vehicles, get the copy of the RC book, whether it is in the name of the company or in the name of the director. So we have to keep our audit procedure also very clear. The second requirement is you have to give under capital work in progress, what is the aging schedule of the capital work in progress. That means you have started a project or you are going to install certain machinery for which you have already started the working. Some expenses has been incurred. What is the period for which it is outstanding? There is a format which I have suggested based on the guidance note. What it is actually, I have given that in note number 1A. Some of the items are talking about note number. We'll see the note number a little later. Note number 1A is nothing but the columnar format in which you have to fill the data. And note number 1B, it also asks you not only aging, what is the probable completion expected or estimated? That should also be given. That is given in 1B. And 1C, sometimes you have started your project, but it is not yet completed, or you have delayed the completion of the project. That may be because of COVID-19 related or any other particular scenario. And you wanted to explain to the person, don't go by the aging analysis alone. These are all the reasons why it is outstanding for more than 1 year or outstanding for 2 years, or maybe some litigation. So in that case, I have added one additional note. This I have mentioned as optional. This is purely optional. If you wanted to show that, you can do it. Otherwise, the actual requirement is only 1A and 1B. Similarly, under intangible asset, same requirement of whether the intangible assets are revalued more than 10%, whether registered valuer is used. If so, what are all the changes? All the items are to be given as per the options given in PPE. Similar to capital work in progress, there could be a possibility of intangibles under development. Similar requirement, aging analysis of intangibles under development. Normally, software companies will have intangibles under development. Pharmaceutical companies will have intangibles under development. Any other company which is having research and development as an activity to develop a new technical know-how will have this. In all those cases, you have to be careful to talk about this aging analysis of intangibles under development, and whether intangibles, when it is expected to be completed and put to use, and if it is delayed, what is the reason? Again, this the third one is optional. This is one thing which I have seen when we are showing that format I will discuss on capital WIP and intangibles under development with the aging schedule. There may be some problem arising out of the aging schedule. We will discuss that a little later. And loans and advances. What it says is that whether any loan or advance has been given in the nature of loan, advance given in the nature of loan to promoters, directors, key management personnel, and other related parties that are repayable on demand, or without specifying in terms of period for repayment. Two possibilities. You might have given a loan or you may not have given a loan. If you have not given a loan, simply say the company has not granted. If you have given a loan, then you have to identify to whom it has been given. Then you have to give the columnar basis. Promoters, what is given, directors, what is given, key management personnel, what is given, what is the amount which has been shown under non-current or current. Current is which is repayable. And the most difficult part of it is, or dangerous part is, what is the percentage of total loans and advances in the nature of loans. So what is the amount given to the director and the percentage to the overall loan may be 90%. You have a problem, especially private limited companies. The possibility of deemed dividend may arise. 2 subsection 22E of the Income Tax Act may arise. But at the same time, if it is given to the key management personnel as part of the employment conditions, given to all the employees, all of them are entitled for taking housing loan, all of them are entitled for taking car loan. In that case, put them under key management personnel, but the key management personnel may be directors also. Classify either directors or under key management personnel and explain that, and say as a reason, this is being provided as terms of employment as applicable to all the employees of the company. Then your problem of deemed dividend will not come. Okay. And in the other financial asset, I have said that you have to add one more item on the face of the note, security deposit, and reclassify all the items. And in inventory, this is actually my suggestion, because you have certain reporting requirement. Client may accept, client may not accept, but you have to be careful whether the client has physically verified the fixed assets, and in that whether there is any variance of 10% and more has happened. This might have been discussed in your CARO report. For that purpose, management is confirming that we have carried out, we have not identified any item more than 10% for each class of the inventory. Or if there is a difference, they are actually giving that information as well. Normally, they will say they are not considered any discrepancy, and if it is discrepancy, it has been properly adjusted. There ends the matter. You need not give any details on that. Then trade receivable, again, there is one problem which is coming in. Neither due from directors or other officers of the company severally or jointly with any other person or any other trade or other receivable or due from firms, private companies, respectively, in which director is a partner, director or member. Now, the problem here is whether we have any issues relating to Income Tax Act. My feeling is trade receivable being a normal activity, it is not a loan, and to that extent, it will not end up with having deemed dividend. It's a trade receivable. Only sections where you have to be careful is 185 of the Income Tax Act, 185 of the Companies Act, 186 of the Companies Act, 188 of the Companies Act. 185 is any loan or advances in the nature of loans which has been given. So directors you cannot give for a private limited company, or relatives to directors you cannot give. Firm in which director is a partner you cannot give, or any other person you cannot give. But to another company in which he is a director you can give. Only thing is special resolution has been passed. That is what section 185. But at the same time, we have to evaluate any other problem you have. Trade receivable can be there. In respect of trade receivable, I don't have 185 because it's not loans or advances in the nature of loan. Section 186 will also not come. It is not loan or extending a security or giving a guarantee, etc. So threshold limit is not applicable. Only section 188 relating to related party transaction has to be taken care, because section 188, along with you also have your AS 18. AS 18, you are making some disclosure. Whatever disclosure you are making there, you have to align here also. Otherwise, you will get into a problem. Two different information will be given. That is the reason why I have not given a breakup here. I simply put that the receivables due from the related parties are furnished in note number so and so. This note is nothing but related party note. Idea is simple. Idea is trying to make it, even if you want to commit a mistake, we will not commit a mistake. We are simply diverting him to see the related party disclosure. And this risk profile is applicable only to India's companies, not for India's companies. Normal companies, this is not relevant. Only for India's company, it is required. But aging schedule of the trade receivable is required. I have given in note number 3. We will look at that little later. Similar to that, loans and advances which are classified in current also, we have to disclose whether it is given to employer, promoters, directors, etc. And unbilled revenue. Some project companies, software companies, IT and IT-enabled service companies, those companies will raise bill on the customer only after a milestone has been reached. But for preparing the financial statement, what they will do is they will accrue the income as unbilled revenue. How long this unbilled revenue is outstanding, they wanted to assess. That is, again, they are asking for aging analysis of unbilled revenue. Okay. This note 9 is applicable only for an India's company, not for others. So it is only for India's company it is applicable, not for regular cases. And shareholding for promoters, it is applicable to all companies. What you have to talk about: promoter, number of shares held, what is the percentage of shares, what is the change in during the year. Now, somebody has asked a question which I said I will take it up at that appropriate time. What is meant by promoter for a private limited company? The person who has promoted the company. So I will simply take the consideration. Those who are subscribers to the memorandum are considered to be promoter. It is not only promoter, promoters group also. Their relatives will also become promoters. Okay, their sons, daughters to whom their shares are being given, they are considered as part of the promoter group. That is a normal way in which SEBI has declared promoters group. We will borrow the same principle for a private limited company also. But for you to simply start with subscribers to the memorandum, how can it be a non-current if repayment is not specified? Okay. So repayment is not specified. Also, people used to show loans given to directors and say that in their audit report also, they will say, in respect of loans given to the directors, no terms of repayment has been mentioned. So it is not repayable on demand. If it is repayable on demand, it will be a case of what you call, it's a short-term loan or current loan. Whereas in respect of case where I am not going to call it within the next 12 months, no repayment schedule has been given, and I have the right to repay at my own convenience, it may be still non-current. If shares were transferred to new shareholders, can they be called as promoters group like private placement? Possible, Harish, because you have to see whether the management changes. For example, when I hold 100%, I wanted to unlock my potential, I may be offering to somebody else 20%, 30%, but I retain the control. So that means I'm still the promoter and they are only shareholders, non-controlling interest. But if I'm allotting my private placement, high stakes to them and my reducing my stake, could be a possibility of they are taking over the control of the entity. So by understanding this change, you will also see whether the management is getting changed. The person who are going to take over the company is considered as a promoter group. So based on which you will consider. Only one thing which we were having here is, it simply talks about shareholding, shares held at the end of the year, percentage of the shares and change during the year. For it is not mentioning the previous year shares held. This is a format given in Schedule 3. I am straight away taking it. But for my clients, I am suggesting them to have shares held as on 31st March 2022, shares held on 31st March 2021, change as a percentage of change. What is the percentage of total shares, and then what is the percentage of change? It will be more easier. Even if I'm not wrong, the guidance note also says like that. But this is a format. You can simply do this also, no problem. SOC again will apply only to India's companies, not for others. And long-term borrowings, what is the purpose for which it has been allotted, whether it has been used for the same purpose? If there is any deviation, you have to mention what is the reason for exception, why you have used it differently. Here, one of the example which has been given is also talks about, I have taken a term loan, but I have placed it unutilized money, I have placed it in fixed deposit. That is also considered as not used for the purpose for which it has been raised. So you have to say amount placed in fixed deposit, because to avoid the or maybe reduce the borrowing cost impact on the company, you can explain that also here. One more requirement is whether registration of charges has been done within time, or satisfaction of charges have been done in time, modification of charges have been done in time. Normally, we don't do this. By default, we consider that everything is all right. Now, it has to be necessary work which we have to carry out and see that particular item. And then this lease liability, I can say it is only for India's company. Short-term borrowings, as I have already mentioned, borrowing against current assets is what is your loan taken for working capital limit, and current maturities of long-term borrowings is what is split. Previously, it was shown under current liabilities. It is a new requirement. And what are all the other possibilities I have given? Lease liability under current liabilities is also Ind AS. Because of Ind AS 116, this comes in. Trade payable, they are asking for an aging analysis, right? CSR, if it is applicable, they are asking for a disclosure requirement. Here, they are trying to capture what is unspent, what is carried over, and whether the company has deposited the money within time with a special fund, or they are going to apply for any, they have transferred to the government account. They wanted to understand the reason, and also in respect of amount spent during the year, they wanted to identify for what purpose it has been spent. This is something unique this period. Reason for shortfall is also new. And apart from that, they are also asking whether the CSR expenditure is incurred through some relatives. For example, the group may be having a trust. The entire amount has been met by the trust. then you have to make a disclosure of the related party also. So here I am referring that to the related party disclosure. And you can also give the breakup like this in case if you wanted to give CSR given or donations given for various categories of this. What is the trust, what is the purpose, etc. So up to that is the amendment required. Now I am taking through the format which I have suggested for aging and the practical issues. For example, in CWAP, I have a problem on this too. What is my problem? CWAP outstanding for more than 1 year, more than 2 years, more than 3 years. What is the reason? Whether the asset really has the potential of becoming an asset or impairment has to come into the picture. This could be a question which will arise in the audit committee, arise in the board of directors, arise in the audit by the auditor. So you have to see what is the reason. That is the reason why we are also having this optional information. Why there is a problem, why there is a delay. That is the reason why I have added optional. And in case you have suspended any project, you have to also give the suspended project. What was expected date of completion? If you have suspended, you have to say whether any project has been completely suspended. Normally you will not have. And then aging of intangible, same problem like what I have seen, 1 to 2 years, more than 2 years. In pharma company, if they are having this type of intangible under development, I will question how you are going to monetize. So the value in use will be 0. Impairment has to be taken into consideration. So in IT and IT enabled services company, they are developing a software, but the developed software never meets the light of the day. All those things will be visible based on this. Company's balance sheet may undergo some changes. Similarly, intangibles under development, what is the completion expected? And what is the delay in completion? What is the reason? You can give optionally. Trade receivable, again, the same problem. Up to 1 year, I may not have a problem, but here I will have a problem. If I say my debtors are outstanding for more than 1 year, more than 2 years, more than 3 years, and there are disputed trade receivable, you should ensure that the provision for doubtful debts has been made according to the requirement. If it is not there, then you will have a problem, right? And this has to be given for both the periods, current year and previous year. But of course, it is not going to restate your numbers. It is only going to be in the notes and accounts. Similarly, unbilled revenue, if I am not billing for more than 1 year, why? More than 3 years, why? In a recent audit committee meeting, this was the biggest discussion where I am one of the independent director. We were asking why it is outstanding, on what basis you believe that this unbilled revenue is really a revenue, whether we have to reverse and make a provision for that. Trade payable, also we have the disclosure, but the problem which I have seen is with respect to MSME. Here only I have worried because in MSMC disclosure, we will say that there is no due to MSME. I don't have a problem. If you are showing a due from MSME, we will say that it is not overdue. 45 days is the time limit given by MSME Act. You will say it's not overdue. But if it is outstanding for more than 3 years, how you are going to say that it's not overdue? This could be an area which can be opened. And apart from that, there are other disclosure required. In case if there are any proceedings happened for Binomi Transaction Act, you have to mention that. And in that case, they have given the framework or format in which it has to be disclosed. I have given that. This is one area where I believe that there could be a problem. Working capital limits, which has been taken more than 5 crore. They have to make quarterly returns according to RBI norms. And whether the quarterly returns are matching with the financial statements, matching with the books of accounts is what auditor has to give a remark. Going to be a problem for all the private limited companies. And especially for that purpose, I have identified that you can do it like this is quarterly number is for India's company. You can talk about, quarterly number is what we will be giving for the return. Sometimes companies will not give quarterly thing. If it is not given, you have to put the factual statement saying that quarterly returns are not being filed. Company will be filing, but they will say that they have not filed it. In that case, you have to get it in MOR, representation from the management. And then for everything as per financials, what is the trade receivable, what is the closing stock, raw material, WIP, finished goods, what is given to the bank, and what is the difference, what is the reason for the difference. Here, the reason for the difference can help you to identify genuine problem. For example, quantity is not changing, valuation you have adopted, or you have given the listing only to that extent of the loan taken, not full inventory. Maybe some companies are having that type of policy. Ask them to change it from the current year to match it. But at least for the previous year, you can say that this is being done because of that particular reason. You have to say whether the company is a willful defaulter. Any bank or financial institution has declared. I'm saying no. If it is declared, what is the bank which has declared? What is the date of declaration? What is the details of default? And what is the view of the company in respect of that? In case you are dealing with certain struck-off companies, amounts are outstanding, they are asking you to provide details. That is also, I have created a template. The 2 layers of companies will not apply to major companies. It will be applicable only for the parent company, subsidiary company, fellow subsidiary company, that type of structure. Otherwise, you don't have this worry. And in case if it is there, you have to give. This is going to be a new requirement where you have to do little bit of additional exercise. You may be doing something for your tax audit. Now you are going to do it for other ratios also. You have to give the formula and you are working. That is what you have to give. And if there is a variation of more than 25%, you have to explain that. In case any scheme of arrangement, you have to explain whether that has been in line with the accounting standard. Apart from that, if 2 layers or 3 layers of investment companies are there, whether any round robin of money has happened, for that purpose, they are asking this. For a private limited company, normally this 12 and 13 will be normally 0. Is there any undisclosed income? This could be a situation for a private limited company. If some such seizure has happened and you have declared that an income or surrendered certain income, whether that has been reflected in the books of accounts in the subsequent year. Last year I have surrendered, this year how I am reflecting that, I have to explain. If somebody is doing in cryptocurrency, now that should also be brought in. What is the currency? What is the profit or loss booked? What is the amount held in the close? This is what I have said, that you can give this as a note for comparatives. Here, long-term borrowings have been reclassified. This is applicable to all companies. Lease liability is applicable for only India's companies. So I have given this as part of the disclosure, right? So this is what I believe that is an explanation which I can better give in respect of the amendments to Schedule 3. Now I go back to my presentation. Sorry. Okay. So now, transaction with struck-off companies, is it only closing balance or actual transaction? If there is an actual transaction, there is a big problem. You have to give all transaction with the company, closing balance, both has to be given, Kishore. Okay. Now, there are certain matters which I have identified based on frequently asked question, which I have explained over the period of time. And you can also have this based on the guidance note, because we are almost reaching our timeline. In respect of NBA, finance or Nidhi companies, I have not made any specific presentation. What my suggestion is, put your questions. I think that all the parties are not interested except one person, ANS, is what I have seen, waiting to listen on Nidhi companies. My question is, my request is, what are all the questions you are having on Nidhi companies? I will answer those questions, maybe for another 5 minutes. I will take another 5 minutes extra time from the organizers. With that, we can close the session. For the time being, I will stop my sharing. If any questions on Nidhi companies, I will spend 5 minutes on that. Your questions can be put on the chat box, or any other questions on this session also, you can put it in your chat box. I think we have answered all the questions which has been put on the chat box on the regular basis. Okay. Earning and expenditure in foreign currency, it has to be reported in notes and accounts, as well as, one second, I will open the chat box. It has to be reported in notes and accounts as well as board's report. Whether at both places same figures are there or different, please guide. Sir, there is an worry which we are having under Schedule 3, is that whether the earnings in foreign currency or expenditure in foreign currency should be given on accrual basis or on cash basis. The intention is to go on accrual basis, so please put it on accrual basis. And since you are putting on accrual basis, financial statement is a responsibility of the management. So director's report also should have the same logic. Okay, then the next question. I will answer these questions, don't worry. For that, I don't want extended time period. Maybe the slides I can move first. If I close that, this will not occupy our space. And this Excel file also I will close. I'm trying to give you a sample financial statement also. And I was referring to my guidance note as well. Okay. Now in the chat, what we will try to do is, I will try to take your questions. How to calculate useful life for second-hand machineries if we cannot trace the year of purchase? So the first point which I wanted to tell you is that you can better take a technical evaluation for second-hand machinery. Otherwise, it is very difficult for us to convince. And normally what will happen is, if it is an imported second-hand machinery, normally second-hand machinery will be imported machinery. If it is a second-hand machinery imported, for customs purposes, they might have declared the origin, the year of original acquisition, and they have fixed a valuation. You can take that, otherwise it is not a problem. Whether any penalties for wrong disclosure for earlier periods, opening a problematic area, sir. In case intentional, there could be a possibility, but we have to look into that. And can we account in the books name of the purchase of fixed assets in the name of the directors? Please avoid, because the specific requirement to show that will get into a problem. In case if you are doing it, then you have to necessarily mention the reason behind that. If useful life is determined 10 years and depreciating at 10%, if company uses triple shift, means each year 20%, is my understanding right? You are correct, Ramesh. How do we know that willful defaulter, other than information from company like any source? I think if I'm not wrong, public domain, they also disclose willful defaulters. Okay. One is the management representation letter is required. And another is we have to look into the public domain. Like what we are seeing when the directors are giving that they are entitled for reappointment under section 164 of the Companies Act, we also look into whether their DIN number is deactivated. Similarly, you have to look at that also. Trade receivable outstanding for more than 3 years. If no provision were made, can we make provision this year? That is the best advice, sir. Because at least you can say that circumstances or evidence is given up to the last year. It is expected to be realized. Now it is not there. Then accordingly, it is there. If loans obtained were partly adjusted for personal purpose, repaid old loans, whether any tax implication and deemed dividend provisions will apply, surely it will happen, sir. If you are using it for personal purpose, indirectly you are giving a loan. So that is one area we have to be careful. And the other comments which I am not reading is basically appreciating the presentation. It is always my pleasure to be of use to the fraternity. And I always believe that I learn at every moment. For example, the interaction which you have had or questions which you have raised, this will reflect in my next presentation for the benefit of the next user. So, and for me also, sometimes if I have missed it, it will open up my knowledge base also. That is the reason why I normally agree for this type of session. And once again, thank you for all of you to be making it more interactive. In fact, I was enjoying it like anything, more interactive. And for the organizers for giving the excellent opportunity of doing this, and the Committee of Company Law Board. If rental agreements were expired, do we need to mention that same? Yes. If rental agreements are, no, rental agreements, if it is a leasehold property, you have to consider. If it is due to be repaid, extended, etc., you have to say. Suppose if you have taken only a rent for building and you are paying only rent, I don't think that it's required. Sample financial statement, I will try to give Mr. Ganesh, maybe you have to give me a little bit of time. The reason is it contains some client data, and for some clients, some areas of amendments are not applicable. Because it is not applicable, I have not included in that particular financial statement. I am planning to include all the amendments into that, putting some numbers there so that you will be able to use it for your purpose, but it may require 1 or 2 days. Please allow me, then I will send it to the organizers and you can make use of that. And thank you for all your appreciation. Thank you so much. Since no questions came with respect to the Nidhi companies, maybe I will give it on choice. And the excellent interaction, I must thank each one of you. Now I will hand it over to the organizers for taking it forward to the normal closure of the session. Thank you so much.
Yes, sir. Thank you. Thank you very much, sir. It's actually a very good detailed discussion, sir, which will be, you kept it very interactive as well. So it will be very, very helpful to our fraternity, sir. So 2 points to notify here, sir. What we notified is your energy levels has not dropped. It's around close to 3 hours, sir. It's close to 3 hours after you started your delivering your lecture, but your energy is not dropped. We admire it, sir. And one more thing which I want to tell is so it is very useful, sir. The session is very useful and very interactive. And your enthusiasm to answer the last question as well, that is very, very admirable, sir. Thank you very much, sir. Thank you very much, sir, for the detailed discussion. It will be very helpful for us. Thank you. So the respected other members, we have a continuation session on accounting standards which are applicable to small and medium scale companies tomorrow, scheduled at 5 o'clock sharp evening. So please join that. For today, good night. Thank you all.